Hope you're all doing good. Recently, ICAI has come out with some clarifications. They've come out with some FAQs, frequently asked questions, with respect to, in the scene of COVID environment, is there any change? There was some uncertainty regarding the accounting. So they have come out with certain guidance on how to account or how to treat certain items. So we'll be covering that in today's session. Okay. So these are not amendments as such. These are just additional clarification which ICAI has given. Okay. So that's all we'll be covering in today's session. There are some amendments also which has been given by MCA, which we'll be covering in the next session. Okay. Today's session is just going to be the COVID clarifications. Due to COVID, the ICAI has given some clarification and we shall be covering that. As usual, we have covered the whole CA final FR using charts. So I thought instead of giving you some theory notes in para, let's make some charts for the COVID clarifications as well. Okay. There's some clarification or some 30, if I have to be very precise, about 40 clarifications has been given by ICAI, 40 plus something. Okay. All those contents, okay, all those question and answers have just converted into these sort of chart formats. So if you run through these charts, you'll be able to easily just take up those questions. Okay. I know that some of you would have done your CA final syllabus long back. Many things you would have forgotten. Hence, what I thought was, I will just retrace what we have done before. Okay, whatever clarification they're giving now, I thought I'll also give you a glimpse of what we have done before. We've already done charts before, right? So we'll just quickly run through that first. Then we will just take up the current guidance note which ICAI has given, and then we'll take up a few questions, okay, based on this to strengthen our understanding more. Okay, that's how we're going to be covering today's session. Don't worry, these are simple guidelines, additional guidance. Some of them actually was not required, which we have already covered as part of our regular batch. Okay, but still it is there. We'll just take it up. So does that mean what we have done before is incorrect? Absolutely not, sir. What we have done before stays as it is. There's no changes. You can think all of this as additional pointers. Okay, all these are add-ons. Whatever you have studied before remains the same as such. Okay, in amendments, yes, one or two things are there. Even those are slight changes that we'll be taking up in the next session. For now, all these are, you can think of it as additional concepts. Okay. All right, let's get started then, if you have understood. Okay, first clarification is with respect to IND AS2 inventory valuation. We know, we have studied, if you have to just show you the previous chart which we have done as part of our regular classes, this one. This is our old chart which we have done as part of our regular class. We know that inventory should be measured at cost or net realizable value, whichever is lower. And to calculate net realizable value, how do we calculate? NRV is nothing but estimated selling price minus estimated selling cost minus any further production cost or cost of completion. These are the three components we'll consider to find out the net realizable value. Okay. So with respect to net realizable value, there are some additional pointers or guidance given by ICAI with respect to the COVID environment. What is that? Let's look at that. Now, lockdown in India happened somewhere in February. Yes. Or maybe first week of March or last week of February, lockdown happened. Things were all going good, full rosy picture. Everyone were happily doing their things. Things were smooth till then. But suddenly lockdown was announced. We thought it will last for 1 week. It went on for 2-3 weeks. Then we thought it's going to ultimately kept on prolonging, correct? So it was a long duration of lockdown for all of us. Yes, we had some tough time, just bearing that. So from the business perspective, now you think many of the factories were shut down. Yes, all their employees had gone back to their respective places. There were no production happening. Forget about the production, even routine administrative activities also many of them were not able to do. Let's take an example of if you are in hospitality industry or if you are a fashion, if you are dealing with clothes, those sort of things. You hardly went for shopping. Forget about shopping. You hardly went to the next road. Correct? No. Where was the shopping? Yes. So they had a lot of goods which they had already produced. Things were good. They thought they'll sell it at a good price and make some profit out of it. But in the COVID environment, do you think they'll be able to sell it? They'll be able to recover what they thought? Let's say an organization, let's say A Limited, they let's say they were clothes manufacturers. They manufacture the clothes and they sell it. Okay, that's their business. So they thought that initially they're going to sell a particular piece of dress material at, let's say, 1,000 rupees. I thought they're going to sell. Normally they sell this material at 1,000 rupees. So they thought they're going to sell it at 1,000 only. Now, due to lockdown and due to many things which happened, which affected the business adversely, do you think this company A Limited will be able to sell that dress material at 1,000 rupees only now? Or the price would have come down? Many of them had to give huge discounts on their products just to make the sale happen. Yes or no? Yes. So let's say this A Limited estimates that the selling price is going to be, let's say, 700 rupees. The estimated selling price has fallen to 700 rupees. Okay, they feel if they sell it at 700 rupees or if they price it at 700, then only they'll be able to sell the product. Otherwise, they'll not be able to sell it. That is what A Limited feels. All right. Now the question which was arising from the accounting perspective was, let's say this estimates after lockdown A Limited, we'll write it this way, after lockdown, or let's say after balance sheet date, because of most of the organizations resumed only by what? July, August, yes, no. So after balance sheet date, let's say the balance sheet date is 31st March 2020. All right. So after balance sheet date, on let's say on 31st July 2020 or something, A Limited resumed their operation. They thought, or they came to a conclusion that we'll be able to sell it only at 700 rupees, or let's give the price discount and we'll be able to sell it at 700 rupees. Now the question that was arising is, when this company A Limited prepares balance sheet on 31st March 2020, they have to value their inventory, correct? And inventory should be valued at cost or net realizable value, whichever is lower. Let's say the cost of this particular dress material is 800 rupees. To manufacture all this material, it takes about 800 rupees and the company sells it at 1,000 normally. But due to COVID, the selling price has fallen to 700. That means there's no selling cost. We'll take this as estimated selling price after all the adjustment. After deducting all the expenses, selling expenses, this is 700. That means indirectly, what am I telling? This is NRV. NRV as on 31st July has come down to 700 rupees. Okay. But when this particular company A Limited, when they are valuing their inventory on 31st March 2020, correct? They should value the inventory at cost, which is 800 rupees, or net realizable value. What is net realizable value? Will you take net realizable value to be 1,000 rupees, which is there on the balance sheet date, or now, which is 31st July, which has become 700? Should we value the inventory by taking NRV as 1,000, or should we take NRV as 700? This was the issue many companies were facing as such. Okay, basically the selling price has fallen after the balance sheet date. Should we consider that fall to find out the NRV and value the inventory at such reduced NRV or not, was the question. Alright, this was the problem. Now what ICAI guidance has given us, okay, if you just check, any fall in the estimated selling price after the balance sheet date should be considered for NRV calculation. ICAI has clearly told that any fall, meaning the selling price has fallen from 1,000, it has become to 700. So that means there is a fall. This fall in NRV should be considered for inventory valuation, meaning NRV should be taken as 700. That means here inventory cost is 800, NRV is 700. That means inventory will be valued at cost or NRV, whichever is lower. 700 being lower, will value it at 700 itself. And logically also it makes sense, because NRV is what? It is the estimated selling price. Alright. So if organization itself is estimating that they're going to sell it at 700 rupees, why should we not take it? Okay. Alright. Because all this, the balance sheet date itself, A Limited knew that due to COVID, they would have to revise their selling price, because many things changed due to the COVID scenario. Yes. So all these conditions was existing on the balance sheet date. Further evidence, meaning further fall, you came to know after balance sheet date. So if you want to link it to Ind AS 10 events occurring after reporting period, this will be treated as an adjusting event. Okay, that sense also if you want to remember it. Okay, so this is the funda. So simple funda is any fall in the net realizable value or any fall in the estimated selling price, though the fall has happened after the balance sheet date, it should be considered for NRV calculation. This is one clarification that they have given. All right, simple. Second one, write down of inventory. Now here in this example, the cost of the inventory was 800, but NRV was only 700. That means inventory obviously should be valued at 700 itself. There is a fall of how much? 800, or rather 100 rupees. So you are writing the inventory off by 100, right? So that inventory written off or write down of inventory to NRV should be disclosure. This is a disclosure requirement. If you are bringing the inventory to its NRV, if you are showing the inventory at NRV, all right, that has to be separately disclosed. These are the 2 pointers which ICAI has given through its FAQs. All right. So I believe no confusion with respect to this. Okay. Hold it. There is one more clarification which has been given with respect to IND AS 2 itself. That is with respect to fixed overheads. What about fixed overheads, you might ask? Now, if you remember, originally when we covered IND AS 2, I had told you, if there is any fixed production overheads, right, those fixed production overheads should be absorbed based on normal capacity or actual capacity, whichever is higher. You have to take normal capacity or actual capacity, whichever is higher. That's how we absorb fixed overheads. Yes. All right. Now, the issue or the problematic stuff was many companies that closed down their factories. So that means they were not producing the goods or the production was very low. Though their normal capacity was much higher, their actual capacity or actual production was much lower. Even negligible for many companies as such. Yes. Okay. So now the question was, the clarification or the question that was arising is, how should the companies absorb fixed overheads? Should they take normal capacity in this COVID scenario? Okay. Or should they take actual capacity, which is actually very low in COVID scenario? Okay. This was the issue. This actually, there's no clarification required. We know fixed overhead should be absorbed based on normal capacity or actual capacity, whichever is higher. This we have done. Apply the same rule. That's what they have just given additional guidance on. And if there is any unabsorbed fixed overheads by chance, all right, then that will be your abnormal loss, which will be transferred off to your profit or loss account, P&L account, or SPL, which we used to call it. Okay. Think we understood the theory. Maybe let's look at small example just to make sure we have strengthened. What do I mean by that? Or let's understand. I've already told you when we did the class, I've explained you the logic of this. Why do we take normal capacity or actual capacity, whichever is higher? What's the logic behind that? Maybe some of them are watching our video for the very first time. Just for their benefit, let's look at the logic of this so that you'll be able to understand why ICAI reiterated this. Okay, this was in fact there already. There's not additional guidance. This was already there, which Institute is further telling. They're bringing this to the limelight now. That's all. Macha idide nodi. Yeah, be aware. That's what they're trying to say. Yeah. All right. Okay. Let's look at a small example here. Let's say there is one company. We'll call it as B Limited. Let's say they manufacture and sell calculators. They produce calculators and they sell calculators. That's their business line. Let's say there is a factory rent. B Limited, let's say, pays about factory rent of 10 lakh per annum. Or 10 lakh rupees, or 10 lakh, we'll take it. This is the factory rent. To produce calculator, obviously, we require a premises. B Limited does not own that premises. They have taken it on rent. Alright. So they're paying a rent of about 10 lakh rupees as such. Okay. Normally, this company produces about 1 or let's say 10 lakh calculators. Normally, before COVID environment or before COVID, this company B Limited was producing about 10 lakh units of calculator. That was their normal capacity. They have a capacity to produce about 10 lakh calculators. But this time, due to the COVID scenario, the actual capacity, let's say, was only 100 calculators. Yeah, the factory was locked down was in a lockdown. We were in a lockdown for a long period of time. Even after that, to reset, it takes a substantial period of time. Okay, so due to that, let's say this company was able to produce only 100 units of calculator this year. Okay, so this is 10 lakh units is your normal capacity, 100 units is your actual capacity. Now what does the standard say? Fixed overheads, fixed production overhead should be absorbed based on normal capacity, which is 10 lakh, or actual capacity, which is 100, whichever is higher. That means actually you should take 10 lakh as to find out that absorption rate as such. Okay, so what will happen if we take 100? Let's for a moment take 10 and see like 100 units and see what happens. Let's find out the absorption rate. Basically this 10 lakh fixed overheads, okay, will be absorbed by 100 units. That means what is the absorption rate for 1 unit? 10 lakh divided by 100. How much is this? 10,000 or 1 lakh? Yeah, 10,000 rupee, 10,000 per unit. So that means check what is happening here. On one calculator, you are giving fixed overhead of 10,000 per unit. Now you tell me logically, will anybody be able to sell calculator at 10,000 rupees, sir? I've not even considered your raw materials, labor, variable production overheads and all. Just fixed production overheads, if you allocate based on actual capacity, how much are you getting? 10,000 per unit. Can you show 1 unit of inventory? If this company has 1 unit of closing stock, can you show 1 unit of closing stock at 10,000 per unit, sir? Will you be able to sell it at 10,000? People will ask, do they know gold? Is it gold coated or gold calculator? Even gold coated calculator, probably they'll not be able to sell it at that price. Yes or no? Correct? This will be irrational. Okay. Hence, this you cannot follow. Okay. So what you should do is, what is the actual absorption rate is? Fixed overheads, which is 10 lakh, divided by normal capacity, which is 10 lakh, or actual capacity, which is 100 units, whichever is higher. So what is higher here? Obviously normal capacity. That means you do 10 lakh divided by 10 lakh, which is 1 per unit. 1 per unit. This is how it will work out. So tell us the financial statement impact also. Okay. If you are preparing P&L by chance. Okay, old format mein, okay, not as per schedule 3. If I'm just explaining it in T format just for simplicity, that's it. Now factory rent is an expense. Used to write here to factory rent, correct? No, factory rent was how much? 10 lakhs. So factory rent will come on the expense debit side. Now how much was the actual units of calculator this company produced? 100 units. For simplicity, let's assume that entire 100 units of calculator is unsold, not yet sold by the company on 31st March. If it is unsold, then what do? You have to show it as closing stock. Yes, that means you will write here by closing stock. How many units of closing stock? 100. Okay, just for the simplicity, we'll assume that the direct material, direct labor, variable production overheads are all not there, just for this example's sake. Okay, for that we will leave that. So what is the only cost for the purpose of inventory? Just we are assuming is fixed production overheads, which is factory rent. How much is that? What is the actual absorption rate? 1 per unit. How many units are there with you? You have 100 units, and each unit you will absorb 1 per unit. That means you will put how much total in closing stock? 100 rupees. Okay. Yes. 100. Correct? No. 100. So that means what is happening here, sir? Balance is nothing but what? Unabsorbed overhead. That is abnormal loss. Where will abnormal loss go to? P&L. So you'll just write here by abnormal loss the balance 9,99,900. It is loss which gets transferred to P&L. This is the clarification they have given. Okay. This we have already studied. This is just they are reiterating it. That's all. Okay. That's what we have written in our charts also. Fixed overhead should be absorbed based on normal capacity or actual capacity, whichever is higher. By chance, if there is any unabsorbed fixed overhead, they will be transferred off to profit and loss account as such. Okay, these are the two areas where ICAI has given some clarification. Okay, now let's look at the question also simultaneously so that it will be easy for you. Okay. This is the actual FAQs which institute has given, guys. They have given in this format, question answer format. But if we do it in question answer format for our last day revision, some of us are time pressed, correct? It will be difficult for us to go through so much and make an understanding out of it. Hence, I've just summarized all of this. This is actually more than 30 pages All the 30 pages ka, I've just I made a summary and I've just tried to bring it down to 7 or 8 pages, those contents. Okay. So now we have learned already IND S2 ka. Let's see if we really have got it. There are few questions, but we'll cover it off. Done now? Okay. Let's look at that question. In the view of significant contraction in economic activity, meaning reduction in economic activity caused by COVID-19, an entity expects significant reduction in its sales in the near future. Future mein they're expecting that the sales volume to be drastically lower. Therefore, it has decided to offer substantial amount of discount on its selling price. They feel we have already produced. If we really have to sell it post-COVID environment or post-COVID period, we really have to give discount because many people have lost their job, many people have taken their pay cuts. So the purchasing power may not be so much. So hence we will not be able to sell it. Hence the only way to proceed is to give discount. So this company has decided to give substantial discount on its selling price and has made public announcements to this effect after March. They brought an open announcement also. We are reducing by our product by 40%, 50%, some discount, huge discount they gave. But the announcement was made after 31st March. This is a keyword. Okay, this was not there on 31st March. Okay, it was made after 31st March. So if you give a huge discount means what will happen to your selling price? It will drastically fall down, reduce. Yes. So there is a reduction in selling price. When is the reduction in selling price happening? After the reporting period, meaning after the balance sheet date. Okay, that's a keyword. How should the entity consider this policy decision while measuring the inventory of its annual financial statements, annual financial reporting date of 31st March? How will you value the inventory on 31st March after, in this scenario is what they're asking. Just now we learned any fall in the estimated selling price, though the fall is happening after the balance sheet date, okay, it will be treated as adjusting event only, meaning you will consider the fall for NRV calculation. So NRV, the reduced price only will be taken for NRV calculation and accordingly inventory will be valued as such. Okay, that is what we wrote in the chart. Now they've just given this question as such. Okay, institute will normally not answer it in 1 or 2 lines. They'll always give lengthy para. Even we have tried to cut short and the answer is a little more actually. Yes. So, but I think you have got the summary answer of it. Yes. The fall should be considered even though the fall is after the reporting period. So till when you will consider? So till the financial statements are approved. Once financial statements are approved, you can't help it. Same like adjusting events. Okay, you had a cutoff, right? Yes, so that cutoff you will consider as such. So that is question number 1 as such. Alright, I think that's okay. I think we must have got it. Yes. So we'll quickly do the questions. We'll not go through because some of you must have been writing your exams in Jan, might be time pressed. Okay. So we'll just quickly now just go through them. Consequent, the next question, consequent to government's decision to lock down all working establishments from March 23, 2020 as a COVID-19 preventive measure in the financial year ended 31st March 2020. In fact, they're saying lockdown happened. Okay, all of them are shut. The manufacturing units of entity were not working during this period from 23rd March to 31st March. Since the lockdown was in place, many factories were shut down. Okay. Hence, the annual production capacity has reduced for financial year 1920. Annual production capacity means what they're talking about is the actual production capacity. They're saying the actual capacity has reduced because of this lockdown. In this scenario, what should the entity's approach to allocate fixed production overhead be while determining the cost of inventory? What they're asking. We just now learned fixed overhead should be absorbed based on normal capacity or actual capacity, whichever is higher. Okay, but due to this COVID environment, most of the entities' normal capacity was much higher than the actual because actual they were not functioning at all. Yes, all right. So, but you will write like this: fixed overhead should be absorbed based on normal capacity or actual capacity, whichever is higher. And if there is any unabsorbed fixed overheads, they will be transferred off to P&L. That is what we have written in the chart. Kindly bring the same here as well. Okay. Extra pointers if you require means you can refer our old notes. Okay, there we have given extra as such. Now we'll be covering it in gist. Okay, this was the clarification with respect to the inventory. One moment, I'll just go for the next one. Okay, next one is Ind AS 16 property, plant and equipment. The problem here was, since the factories and premises, office premises and all were in lockdown, meaning they were shut, many assets companies were not using at all. Companies were hardly using their assets. Now the question was, should the company calculate depreciation on those assets? Till now companies were using the asset. So that means they were getting some benefits. Okay, we know that matching principle. Yes, for every revenue there will be a corresponding expense. So we used to calculate depreciation also as a matching principle as such. But now many organizations are not using their property, plant and equipment. During this lockdown period also, should the company calculate depreciation on their PPE or should they stop was the question. That was the problem. Okay, so this, what do you think rationally should have been done? Or I'll read the example that I gave you before this, or that I had given in the class. I don't know whether you remember it, but still I think I'll just go for it. Let us say all of you wrote your CA final exams and you cleared also. You cleared. Okay, you're full happy. You're so happy that you bought iPhone, let's say 10, or maybe I think 11 and 12 is the latest version. Okay, you bought iPhone 11, sir. You paid about 70,000. You paid 70,000 and you bought iPhone 11. Super happy you were. You have one of your brother. He's in US. You told him, hey, I cleared my CA final examination. He thought, I already knew that you will clear. That's the reason I have already purchased iPhone 12 for you. He purchased iPhone 12 for you by paying 1 lakh rupees. Okay, and he sent you also. So on the same day, you purchased iPhone 11 for 70,000. On one hand, on right hand you have iPhone 11. And your brother gifted you iPhone 12. Now naturally, what do you think you'll use? iPhone 11 or iPhone 12? You saw, I said, idu tuka jasti. Yeah, alright. Yeah, so you obviously will use what? iPhone 12. You are super duper happy because you cleared one of the toughest courses in India, right? Yes. So you were busy. You didn't go to the shop and all. Let's say you bought this from Reliance Digital. You were full busy. For the time being, you thought, okay, who will go to Reliance Digital and all, exchange and all for the time being. You kept this phone in your cupboard, sir. You kept it in your wardrobe and you went for all India trip. Anyway, you struggled a lot, you studied so much, you wanted to have a break. So you took your car or bike or whatever and you thought, I'll do India Darshan. Okay. So you went. After 3 months, you came back. 3 solid months full, you roamed India, left from north to south, east, west, everything you went. Okay. So you covered. After 3 months, you came. Okay. Then you realized, oh man, I've kept iPhone 11 with me only. I forgot to exchange. Sir, it's a box piece, brand new piece. You have not even opened it. The moment you got iPhone 12, no, you forgot about iPhone 11. You didn't bother even to open the box to see whether actually iPhone 11 is there or Dabba is there. Okay, that also you didn't do. You kept it as it is. Okay. Now, so you thought, okay, anyways, it's okay. So, jo ho gaya, so ho gaya. So you took this phone. You went to Reliance Digital, newly qualified CA and all. You started giving full India 16 ka gyan, sir. You told him, this is a property, plant and equipment because it's a tangible item. It is held for usage is for more than one period. There is future economic benefits. There is cost measurement. Full gyan you are giving, India 16 ka, and telling him that this is a property, plant and equipment. Shopkeeper looked at you crazily and told, Yen bek, why are you eating my head so much? Tell me, what do you want? Then you came to the matter and you told, sir, I had purchased this iPhone 11 for 70,000. Okay. Brand new box, bill also is there with me. I have not even used it for a single day. Forget about using, I have not even opened it. Okay. Kindly return 70,000 to me. This is after 3 months, okay. After your India Darshan. After 3 months, you are asking 70,000 back. What do you think Reliance Digital guy will tell? Munduku go. Yes, go forward. Yes. Will he give you 70,000? He looked at your face once again. Okay, and he told, I will give you 50,000. Want means take. Otherwise, go. I will give you 50,000 maximum. If you want to take, otherwise get lost. Okay. Now you tell me, relate this concept and tell me. From 70, the value of this phone became 50. Due to usage, the value reduced. You have not even opened this phone. But is the value same or it got reduced? Value has reduced. Why did its value reduce? Due to passage of time and due to technological factors. That means depreciation on property, plant and equipments of a company. Should you charge just on the basis of usage or even passage of time and other technological factors and other things also has to be considered. So what is the whole funda of this? during the lockdown period, if you have any asset, any property, plant and equipment or intangible assets for that matter, if you have not used it, doesn't matter, depreciation will still continue. So depreciation accounting will not be stopped for that lockdown period, okay, but it will still continue as such is the first clarification, and rightly so. Okay, this is one clarification. Okay, but we have already learned there are various depreciation methods. We have straight line method, WDV method, units of production method. Like this we have many. Yes, no. IND AS 16 does not give you any guidance as to which method you should select. IND AS 16 only tells what? Choose that method which reflects the pattern of economic benefits. Okay, which method reflects the future consumption of benefits? Choose that method. IND AS 16 is what it says. Okay. Let us say a particular company is following units of production method. How does units of production method work now? Okay, let's say there is a machinery. The machinery cost, let's say, is 10 lakh. Let's say salvage of the value of that machinery is 0 for simplicity. Okay, this company, let's take this as X Limited. They are following units of production method. Let's say X Limited, they're using this machinery to produce a goods. Okay, they feel total units that X Limited, this company, can produce using this machinery is about 10 lakh units. Using this machinery, the company can extract or take out about 10 lakh units. In the current year, sir, due to COVID, they produced 0 units. Company was in a lockdown for many months. After that, they were short of money. Okay, they had to do a lot of other things. Hence, they could not start their production this year. They felt this year is oofy. We will skip this calendar only. We will not even think. Okay, we'll forget that this year happened and we'll concentrate on the future. Is what company thought. So they did not produce even a single units this year. Can you tell me how does depreciation work under units of production method? How do you calculate depreciation? Original cost minus salvage value, which is 0, divided by total number of units or total expected production from this machinery multiplied by number of units produced in the current year. Yes, total units divided by number of units produced in the current year. How many units was produced in the current year? 0. That means how much is depreciation? Obviously 0. Yes. So what is the funda of all this? If a company is using units of production method and if the company did not use that asset to produce any goods, then that company will not have any depreciation as such. Okay. Is this due to COVID? Not necessarily. This is the feature of that method. If usage is there means depreciation also will be there. If usage is not there means no depreciation. Usage could not be there for many reasons. COVID is one of the reasons. The company could have not used this machinery due to breakdown of machinery or labor strike or their mercy. Yes, whatever. If usage is not there, then depreciation will not come. When? Only under units of production method. That's what I've written here. If company is using units of production method and if asset is not used, then for such companies, no depreciation will come. For all other companies who are following straight line method or WDV method, depreciation will happen normally as usual. No change. Keep continuing. That's all. Is he? Not a big deal. No? I mean, very straightforward provision as such. Yes. Okay. Let's, okay, I think the question is way too simple. Okay, we'll quickly maybe go through it just to be sure. Consequent to government decision to lock down all the working establishment from March 2020 as a COVID preventive measure in the financial year ended 31st March 2020, the manufacturing units were not working and plant and machinery was lying idle during the period 23rd March to 31st March 2020. In this scenario, should the entity discontinue depreciating this PPE from those dates? Since they are idle, should we stop depreciating is what they are saying? No. Depreciation will still continue. That is answer to the first question. Second, should the entity suspend recognizing depreciation for these items of PPE which are depreciated using a method other than number of units of production? They are saying this company is not following units of production method. They are following some other method, maybe straight line or written down value, such as straight line method or written down value method. For the purpose of for the period those have remained idle. Alright, they are saying suspension. If you remember Ind AS 23, borrowing cost. In borrowing cost, there is a provision. What is the provision? When should you commence the capitalization of borrowing cost? When should you stop? Meaning cessation of borrowing cost, we call it. When should you stop capitalization of borrowing cost? And also there is a specific provision of suspension of borrowing cost. Alright. But in case of Ind AS 16 property, plant and equipment, there is no suspension provision. If you remember, check our old charts. Nowhere we have written about suspension. We have only written what? When should you start depreciating property, plant and equipment? When will you start? When the asset is ready for management intended use. When the asset is management ready, that's when, not put to use, ready for use. Okay. Moment when the asset is ready for use, management intended use, you start depreciating that property, plant and equipment. When will you stop depreciating? When the asset is either classified as held for sale, Ind AS 105, yes, or when you de-recognize the asset. When will you de-recognize? When you sell the asset, or when FEB stops, or when you've donated the asset, or when you have given it on finance lease. Yes, could be many reasons when you can de-recognize. So when you de-recognize a property, plant and equipment, okay, that's when you stop depreciation. There is no suspension provision for Ind AS 16. That means depreciation will happen as usual, no change. Okay, answer to this is also no as such, no suspension. Continue depreciation as normally. Okay, we've given you full-fledged answers. I'm just giving you short answers here as such. Okay. Oh, one moment. Excuse me. All right. So we've covered two things so far. Next provision. Ind AS 36, impairment of assets. Yes. All right. When will you impair, or when will you calculate an impairment on a particular asset, be tangible or intangible assets? You learned, right? Impairment you'll only do when there is an indicator. You'll do an impairment test only when the indicator exists for a certain assets like goodwill arising on business combination, intangible assets with unlimited useful life. Okay, those you do at least annual impairment check. But for others, you do the impairment check only when the indication arises. This is our old chart. Check, we have written already. Conduct impairment test only if indication exists. Okay. All right. So what are those indicators? That also we have written here. Check. Indicators are of two types: external indicators and internal indicators. We have already written here: market value decline, changes in technology, loss of KMP, continuous losses, etc. Various indicators are there. If those indicators arise, then you do impairment check. Okay, meaning impairment test you do. That means what do you do in impairment test? You have to find out something known as RA. RA means recoverable amount of the asset. If you're doing impairment test at cash generating unit or CGU level, then find out the recoverable amount of CGU. Compare the carrying amount of the asset or CGU with recoverable amount of the asset or CGU. If carrying amount is greater than the recoverable amount, then only you book something known as impairment loss. Okay, this is what we had studied in our, as part of our regular course. Okay. Now, what is the clarification with respect to this, sir? Is COVID an indicator? Is lockdown an indicator for impairment? Okay. Should all the organization went through this COVID process, right? It was blanket. Everyone had to follow. So that means, does every organization, or for every organization, is this lockdown an impairment indicator? Meaning, should all the organizations now find out recoverable value of their assets, either at the individual level or at the CGU level? Okay. Should they do was the question. Because to find out recoverable amount is not an easy exercise case. We have seen recoverable amount is higher of two things: net selling price or fair value less cost to sell with value in use. Okay, you either higher of two things: net selling price or value in use. Whichever is higher, that you take it as recoverable amount. And finding them is not an easy task. It's a substantial process. Okay. So the question was, everybody should do impairment check now, was something which was bothering. ICAI has given a clarification. Okay. And rightly also, or maybe you only think, just because lockdown happened, was it a bad thing for everybody? Did every company get affected? No, majority of the business did get affected, but there were some companies who, for them, it was actually a boom period. So what are you talking about? Sir, if a company was manufacturing a mask or a PP kits or sanitizers, or companies like Zoom, all of our classes went on Zoom mode, no? Yes. So for them it was actually a blessing in disguise, no sir? They were like, actually like, for them, COVID was a big boost to their business. Yes. So that means, do you think their assets are really impaired now? They're in the boom period. That means you can't really call that for every business, COVID is an impairment indicator. Some business or majority of the business did suffer. Yes. Alright. For them, yes, COVID or lockdown was an impairment indicator. You find out the recoverable amount. But for some businesses, they also thrived on this environment. Okay, they did good in this period. It was a boost for them. For them, it is not an impairment indicator because they're doing awesome, in fact. Yes. So you can't make a blanket or you can't make a common statement that COVID-19 or lockdown is an impairment indicator and everybody should find out the recoverable amount of their assets now. That is not correct. So that is what they're saying also. COVID-19 could be, check the word I've not written, COVID-19 is, I've written COVID-19 could be external indicator. External indicator, obviously. This is I should do external one, yes. So COVID-19 could be external indicator of impairment because due to COVID, there were some changes in economic environment. Whole lot of things changed. Yes. If somebody had told us wear mask for 5 minutes before lockdown, we would have said, hey, no, I'm not able to wear my specs, my ears are paining, 101 things, you would have given excuses and you would have not worn it. But now, nobody has to tell, we'll wear it all the time, that too, yes? So obviously, many businesses, there has been changes in economic environment and due to this changes for many business, they've had some adverse effect. They've affected their business badly. So hence, COVID-19 could be taken as an external indicator for such, okay? Hence, entity, if it is an external indicator of impairment, if indicator is there means you have to find out what, or you have to do impairment test. Hence, for those organizations whose business has been badly affected or adversely affected due to lockdown, you have to do an impairment test. The moment you do impairment test, will you book impairment loss? No. When you do have to do impairment test, what are you essentially doing? Carrying amount of the asset, you already know. Recoverable value amount of the asset or CGU, you will find out. Only if the carrying amount of the asset is greater than the recoverable amount. Here we written, see. Only if the carrying amount is greater than the recoverable amount, then only you will book impairment loss. Okay. So you just have to do impairment test and accordingly see if there is any impairment loss is there and accordingly account. Okay. That's it. This is the first clarification. Easy. Yeah. Case by case basis you'll have to do. You can't make a common statement. Okay. That's the funda of the first pointer they made. Next pointer, if market capitalization means the total money which the company has raised using the share market, yes. So how do you get that? Number of shares multiplied by the market value of the shares. Number of shares multiplied by market price per share if you do, the value that you get is what we call it as market capitalization. If market capitalization is lesser than the carrying amount of net assets, not one assets, net assets of the whole company. If market capitalization is lesser than the carrying amount of net assets, then also they say it is an impairment indicator. We're not saying to book impairment loss. We are saying if this scenario arises, then this is also an impairment indicator. And if impairment indicator is there, do impairment test. And if impairment loss is there, then only account it as such. Okay, this is the funda. Easy. Or if you need a little further guidance on this, let's say there is one company. They have 1 lakh shares. It's being traded in the market and the market value of one share. It was actually like, let's say it was market value per share was 150 or something before lockdown. Due to lockdown, market value of the share has become 20 rupees, sir. From 150, it has fallen down to 20. Yes, for many companies, the price has been steep. Yes. So how much is market capitalization? 20 lakh rupees. 1 lakh into 20, which is 20 lakh rupees. Now, net assets. Net assets, how do you get? Total assets minus outside liabilities if you take, that is net assets. We have done in consolidation. When you have a control, we always say control. Okay. So like only if control is there means we do consolidation and like that. We do consolidation is what we were saying. Yes. So in fact, when they say control, what do they mean? What does one company or what does we say holding company control subsidiary company we say. Essentially, how is holding company controlling subsidiary company or what are they controlling in subsidiary company? Subsidiary company ka assets and liabilities holding company are able to control, meaning net assets of the company we are able to control. Okay. Let's say net assets you calculated for this company, that is 30 lakh rupees. You did assets minus liabilities, you computed. Let's say that value came to 30 lakh rupees. Now you just check. if somebody wants to buy 100% stake in A Limited, somebody wants to buy this company, buy off 100% stake, how much really they need to spend to get the control over this company? 100% stake. How much they need to pay? They have to buy back 1 lakh shares. Each is being traded at 20 rupees now. Okay. So that means if they pay 20 lakh rupees, they will get control of this company. Yes. But that means, can I say the worth of this company is 20 in a way? Yes. But in your balance sheet, net asset is being shown at 30 lakh rupees. Now, don't you think this is giving a little off image? A company is able to control this company just by paying 20 lakhs, but the asset value is being shown at 30 lakhs. That means what? This is also an indicator. The fall in the market price of a share is also what? An impairment indicator. We are not saying book impairment loss. Check. This is an impairment indicator and check if any assets are impaired. Okay, this does not mean straight away you write off 10 lakh as impairment loss. No, check which assets are impairment. This could indicate that some of the assets of these companies are impaired. Like companies usually have multiple divisions. Possible. They will not be into one verticals. They will be into various verticals. It is quite possible that this A Limited is into FMCG and they are into, let's say, hospitality, or let's say they own a group of hotels. This A Limited has FMCG also. They produce some fast moving consumer goods, maybe salt or something. Okay. And they also run a group of hotels. Done? Okay. When they prepare balance sheet, they'll group all this and show it as, total assets you will show in the reporting. Correct? Now, you tell me, due to lockdown, the essential goods were not affected. They were running as usual. People were consuming still all those salt to, the whatever the rice and all, everything, whatever is necessary for a daily life, that was being produced. In fact, maybe it was produced on a larger scale. All of us were eating more during lockdown period. Most of us have put on weight also. Yeah. So FMCG division of this company may not be affected. In fact, that might be going as normal. But hotels, you check. People were going out, as we told, pakkad road ge hogak aagta irlilla. Next road only it was not possible to go. Forget about hotels and all. That means it could indicate what? Maybe some assets which are there in the hotel division might be impaired. Okay. So fall in the market capitalization is also an indicator of impairment. Actually, this guidance was not required at all, because originally if you check our chart, we have already written market value decline is an impairment indicator. These are old charts. Yes, we have already written that. They've just reiterating that. Okay, just telling it once again. Okay, this is also an impairment indicator. You could get some theory questions based on all this, case study questions, 2-3 marks maximum maybe. Alright, let's see how they ask and stuff. These are just plain theories. Next, IND AS 36, that is impairment of assets. It also applies on ROU assets, right of use assets. Okay, if you have taken any asset on lease, obviously lessee has to show ROU. We are not talking about lease, IND AS 116 exemptions here. Okay, low value assets and so on, those exemptions we are not talking about. For normal lease, okay, if there is a lessee has taken an asset, means he will show it as ROU. So for ROU assets also this impairment wala standard is very much applicable. Okay, so meaning you will compare the carrying amount of ROU with recoverable value, and if carrying amount of the right of use asset is greater than the recoverable amount of ROU, then impairment loss will be booked on ROU also. These are the 3 pointers which they specified as part of this guidance. That's all. Okay, right, let's come to the questions and quickly run through those questions. Impairment of assets. Question number 4. COVID-19 global pandemic has caused substantial contraction in entities' business since March 2020, and this depressed business scenario is expected to continue over 6 to 9 months. It will continue on that in the next financial year 2021 as well. Entities are experiencing significant cancellation of business orders. Check this is important. Many orders are getting cancelled. Customers whoever are regular customers, even they are cancelling our orders indirectly, they're saying. And bookings by its customers, all the bookings and all are cancelling. Does entity need to carry out an impairment test to estimate recoverable amount of its non-financial assets for the year ended 31st March 2020? Should they do, basically due to this COVID, should this company do an impairment check is what they're asking. Every company need not do impairment check. Impairment check will only do, we will check is due to lockdown, has this obviously economy has been badly adversely affected, but rather economic conditions have changed or economic environment has changed. Due to that change, you check for your company, is it favorable or unfavorable? If you feel it is unfavorable for your company, then definitely this is an indicator of impairment, and such companies has to find out the recoverable amount, and yes, you have to do it. Now, if you just check in this case, many orders are getting cancelled. That means you think, what do you think here? It's this lockdown is causing a favorable impact. It's having a favorable impact on this company or unfavorable impact? Obviously, unfavorable impact. That means what? This is an impairment indicator. So the company has to find out, or rather has to do an impairment check. That's what they are saying as such. Alright, and that's what they are trying to give on all this point. I've just given a short answer. Yes, it is an indicator as such. Okay. Question number 5. Since the declaration of COVID-19 as global pandemic, the entities market capitalization, the leading capital market has declined. Market capitalization is reduced because market price is reduced, and it is much lower, keyword, much lower than its net carrying amount of its total assets. Okay, so market capitalization is lower than the asset value. So is this an indicator of impairment? Very much yes. If market capitalization is lower than net assets, then it very much is an indicator of impairment. That's what we saw. Okay. Next, an entity with multiple retail outlets located in various shopping malls has taken premises on lease with a lease term of 2 to 3 years. Since it is 2 to 3 years, lease exemptions and all are not applicable. So you have to, since they have taken it on lease, they have to show ROU, right of use assets. You have to show as such. And all this they have taken it in shopping malls. This is only the keyword. Shopping malls. Why? Sir, many shopping malls were shut down. People were not coming out of their house. Forget about shopping. They were not going at all to the shopping malls. Meaning the shopping has significantly reduced. That means before lockdown, let's say this company showed ROU at 10 lakh rupees. ROU, they calculated it and showed at 10 lakh rupees. Now, due to lockdown, shopping trend of people has substantially come down. Do you think now this entity will be able to recover so much money from these outlets? Possibly no. So the recoverable amount will be a lot lower. That means impairment test should also be conducted on ROU assets, and if necessary, impairment loss has to be booked on ROU also. Just now we learned that is the answer, but nonetheless we'll still go through the full thing. According to Ind AS 116, that is leases, it has recognized asset in the form of right of use assets, which is ROU, with a corresponding lease liability. Two things lessee has to show, ROU and lease liability. They have shown it. Unexpected global outbreak of COVID-19 has resulted in its profitability being severely affected due to lower customer footfalls. Many people are not coming to shopping malls. So obviously customers are not coming means, will you be able to sell your product? No. That means the value at which you are showing your assets is heavily overpriced. You are showing asset at a higher picture, at a higher value, which you need to reduce. Over 6 to 9 months as a consequence of customers' behavior regarding health and safety concerns. And does the entity need to perform impairment test and carry out, estimate the recoverable amount? Very much yes. There is an impairment indicator. Okay. For this company, for every ROU assets you need to do impairment test. No. Check. If due to changes in economic environment caused by COVID, it is favorably affecting the company or unfavorably affecting the company. Here, people are not coming. It's a shopping malls. We have taken some premises, some area we have taken on rent in a shopping mall. People are not coming for shopping at all means, obviously it is an unfavorable condition for this company. Yes. So in case of unfavorable condition means, it is definitely an indicator of impairment. So that means you have to find out the recoverable amount and book impairment loss if it is there as such. Okay. That is with respect to impairment of assets. Okay, 1 minute. So we have covered this as well. Let me find out the next one. Hang on. Financial instruments. Our super duper standard. Favorite standard. Correct? No. It took a lot of time to do this as well. Yes. Actually, like, the moment you hear financial instruments consolidation and all, like some sort of, a little fear will be invoked in us. Not that it is difficult, just that it is too lengthy. Yes. But with respect to clarification, okay, financial instruments, I would say, I would not rate this as that important as such. Okay. Why? Because it is related to something known as hedge accounting. Okay. Hedge accounting, our institute material only, they hardly had any problems. Okay. In fact, we did some problems in cash flow hedge and all. Yes. Yeah. So, but as such, institute material, there was no problems as such. So, no problems and all. That means here clarification also not that important as such, but we'll still quickly cover it off. So, first we'll try to understand what are they trying to cover first, or what are they trying to say. Okay, this clarification is with respect to, this is our old chart if you remember, okay, which we had done as part of a regular course. Yes. So, this clarification is on the cash flow hedge. So, first of all, what is cash flow hedge? Do we remember that, or full Tripti it was already? Okay, just as a recap, I'll just tell you into quickly what is that. Let's say a company is there in India. They have some foreign currency transactions. They, let's say, sell some of their goods to an US client. One other client is there in US for which they sell the goods. But client has requested that you have to send the bill in dollars, and he'll make the payment also in dollars only. Or rather, the client is telling, I'll make the payment only in dollars. Okay. But our functional currency, meaning our bread and butter, or the currency in which we are interested in, okay, is what? Indian rupees. But the client is going to pay in US dollars. And dollar value and all is not same. It will keep fluctuating. And this is our big client. On a routine basis, we keep selling goods to him, and we'll keep recovering the money also. Okay, transactions are pretty voluminous, and the value is also quite on the higher side. So if dollar value, like if it keeps fluctuating, it's a big problem for me, correct? No? Because I'm not a speculator. My business is not to bet on the dollar movement. My business is to produce the goods, quality goods, and sell it across whoever the customer that wants it. Okay. So to cover this dollar fluctuation risk, what do? We get into forward contracts. Yes. So that we fix the dollar rate, so that no matter what happens, whatever the exchange rate fluctuates, whether it increases or decreases, our position is safeguarded. We minimize our loss. That's what we call it as hedging, correct? To hedge means to cover the risk. So if you are covering the cash risk associated with cash flows, then that sort of a risk we call it as cash flow hedge. If there's any cash flow variance, how much cash flow we're going to receive? If there is a variance in that, and if you don't want to take that risk, and if you do something about that, we call it as cash flow hedge. That's what I've written here, cash flow variance risk. Alright. So normally, here hedge accounting we have already learned. Here there will be two components, hedged item as well as hedging instrument. Hedged item means what? Hedged item I'm calling it as HI. Hedging instrument we call it as HII. Hedged item means our transaction with our foreign client. That transaction, that foreign currency transaction, we call it as hedged item. And to cover this dollar, what did we do? We got into a forward contract. Yes, we went into a derivative basically. Yes, a derivative we call it as hedging instrument. Okay, so this is clear, I believe, or this recap is okay, I guess. So what we used to do, if you remember our problem, if you just check the problem, you'll know this. We have done a huge problem also based on this. In case of cash flow hedge, obviously, if it's a foreign currency transaction, means dollar value will keep fluctuating, and there will be some gain or loss. The gain or loss on both hedged item as well as hedging instrument will be, we used to tell, this is a bookish loss. This is not actual loss. Actual loss is with respect to your forward contract. Yes, no. We have fixed our losses, but our accounting funda is such that we have to do fair value accounting. Because of that, there will be some gain or loss. So the gain loss on hedged item as well as hedging instrument will be parked in one reserve. Name of that reserve was cash flow hedge reserve. It's an OCI. It will not go to P&L, it will go to an OCI. And name of that OCI component is cash flow hedge reserve. And from cash flow hedge reserve, the actual loss from cash flow hedge reserve will be transferred to P&L over the contract duration. Ultimately, when you recover all the money from your, when the transaction is over, when you recover all the money from your foreign client, that cash flow hedge reserve account should get balanced, meaning the debit side should be equal to credit side. This is what we had done, and we had done a problem also based on this. Yes. Okay. This is your recap of cash flow hedge. This is not what this is not our current scenario. This is just a recap. Now, what was the issue arising with respect to this is, sir, due to again lockdowns and COVID environment, many of your transactions were getting cancelled. Okay, let's say your transaction with this foreign client, which you used to call it as hedged item, what if that only gets cancelled? Before COVID, he was saying, yeah, send me more goods, I want to buy more and all. After COVID, he said, difficult position, I'm not able to make payments and all, I don't want any more goods. He cancelled your order. Meaning, if that hedged item or foreign currency transaction gets cancelled, what should I do for this cash flow hedge reserve? That gain or loss temporarily are parked in cash flow hedge reserve. Should I keep it as it is, okay, or should I transfer it to P&L? This was the issue with respect to cash flow hedge. Okay, the guidance given is if you parked it in cash flow hedge reserve, because as long as the hedged item and hedging instrument both were there. If hedged item and hedging instrument both are not there, alright, rather if the hedged item itself is getting cancelled, that is a foreign currency, future foreign currency transaction, which was highly probable, if that itself got cancelled, then any balance in that cash flow hedge reserve, which was an OCI, correct, should be transferred to P&L. Okay, any balance in cash flow hedge reserve now should be transferred off to P&L. When? Only if this hedged item, that is probable, highly probable future foreign currency transaction, if it gets cancelled. If it is as it is, no problem, continue your normal accounting. Only if this gets cancelled, then balance in CFHR, cash flow hedging reserve, should be transferred off to P&L. That is all the clarification they have given with respect to financial instruments. Okay, there's one question, we will do that first, and then I think actually there's one more comment, which actually we'll look at it as part of the question itself. Hang on 1 minute. Yeah, here it is. Yeah, this one, question number 9. 7 and 8 we'll do it, but this is the question relating to the concepts we just now discussed. An entity was following, or maybe just one moment, some of you are wondering, sir, this notes is not there, where will I get it? Sir, all this notes, these questions along with charts will be uploaded on the app, Arivu Pro app itself. Okay, you can download it, it's free for all. Alright, you can just go into the app and download it off for yourself. Okay, both the COVID charts, not the original charts, this COVID clarification charts, the revised chart which I've made, plus this notes. Not only this, the amendments, even amendments will be covering in similar fashion. I will not give you those big theory notes. I will summarize it in the form of charts so that it will become easy for you to revise. Through the charts only we will learn, and if necessary we'll do 1 or 2 problems or some problems. Even for the amendment we'll have the same structure. That we'll be doing in the next session. Even those notes will be available on the Arivu Pro app. You can download it and print it. That is not a problem. We'll be giving you the soft copy. Okay. Coming back to this question now. An entity was following cash flow hedge accounting. Keyword is cash flow hedge accounting they're following for its highly probable forecasted foreign currency transaction. They've have some foreign currency transaction. Because of that, currency risk is there. Hence, they've got into some hedging. Okay, they've got into cash flow hedging. Okay. Accounting for its highly probable forecasted foreign currency sale during next financial year, that is 2020-21. Transaction will happen in the future date, but to cover our position, we have got into forward contract or cash flow hedge now itself is what they are saying. In the previous financial quarter, the entity had discontinued the hedge accounting. They have discontinued, that is the keyword. However, it had retained the effective portion of cumulative loss on the hedging instrument. There was some loss on hedging instrument. They have retained that in cash flow hedge reserve. That loss, they have kept it in CFHR only, meaning cash flow hedge reserve only, they have kept it as a separate component of equity in accordance with the requirement of Ind AS 109. This is because the forecast transaction was expected to occur as planned earlier, though not considered highly probable. Now, in the view of significant economic uncertainty due to COVID-19, the forecasted future currency sale transaction is no longer expected to occur. Saying that foreign currency transaction itself will no longer occur means that is getting cancelled, or that is expecting to getting cancelled. That's not there. That is only hedged item, no. If hedged item itself is not there, so what do you do in balance in cash flow hedge reserve? Can you keep it in that cash flow hedge reserve as an OCI itself? No, that balance should be transferred off to profit and loss account as such. Can the entity continue to retain the cumulative loss on hedging instrument in separate component of equity or immediately reclassified to P&L? Immediately transferred to P&L. You can't retain it in the OCI component now. Okay, name of that OCI is CF cash flow hedge reserve. You can't do that. You have to transfer it to P&L. That is what we learned it just now. Yeah. There are a couple of questions also. I believe it's pretty easy adjustments. Yes, so far nothing fancy as such. Yeah. Nothing to break our head and all. Easy. Few things go on given. Okay. How can it be tested as numerical? Questionable. Okay. All this, especially during your January attempt now or the May attempt. In the next 2-3 attempts, these things will have a little more weightage. Okay. Normally, whenever there is amendments or extra guidance note or clarifications given, for the first 2-3 attempts, there is a better chance of they getting asked in the examination. Not that they can't be asked later on, this can be asked whenever they want, but the weightage in the next 2-3 attempts could be on the higher side, is my view. Okay. Anyways, next question. Alright. A non-financial institution, okay, has a major part of its financial assets, FA, in the form of trade receivables that result from transaction within the scope of Ind AS 115, revenue from contract with customers. Okay. For the purpose of recognition and measurement of impairment loss for these financial assets, the entity has been following a simplified approach and recognizing lifetime expected, lifetime expected credit loss using a provision metrics based on its last 5 years robust data of loss rates. 5 years historical data they have. Based on that, they are saying they are making provision for doubtful debts, sir. That is what they are trying to say. We make provision for doubtful debts, no? Yes. So, whenever we do audit, first thing we ask for with respect to debtors and all is what? Age-wise report, Kodi. Give me age-wise analysis report. Yes. So that is what they are asking. Okay. That provision matrix, that age-wise analysis report, keeping that as a base, historical data, 5 years ka data. Okay. Based on that, they are making provision for doubtful debts. Okay. So now the question is, in the present economic environment of COVID-19 outbreak, can the entity continue with its old provision, or can they continue with its old provision matrix based on historical? Can they do it in the same fashion, or should they revise, is what their question. Sir, historical data was irrelevant last 5 years ago. Just to give you data, what are they trying to say is, you know, the age-wise analysis report, no, less than 30 days, 30 to 60 days, 60 to 90 days, yeah, more than 180 days. Correct? Like this, we'll have A, B, C, we'll have the debtors here, we'll have the value. Yes. So, like based on this matrix, okay, let's say there is a company X Limited, they have various debtors A, B, C, 1 lakh, 2 lakh, 0, 0, 0, 0, 3 lakh, 4 lakh, 5 lakh in total. Yeah. Like this, they used to give the wage-wise report. This is our provision matrix. They were making the provision based on this matrix. Can they continue to do so now also in the COVID environment, is what they are asking. Sir, all this was good. Actually, this data I have just brought it for 180 days. They have devised this data based on the 5 years things they have, robust data. They have compared that. See, last 5 years there was no COVID. Things were pretty okay for everybody as such. Now, due to COVID, many businesses are suffering. Okay, those companies which were doing good also have actually turned into loss making, or maybe some of them even have shut down because the impact is so big. So you can't go ahead with the same provision matrix now also, because that's based on historical data. Now data has changed in a big way because your COVID has affected. So you can't do that. That's what they're saying here. Check. The entity shall adjust the historical information. Whatever data you have, you adjust it for the current observable data. Now you just check what is the position of this A Limited. Has COVID affected severely to them? Okay, you just check what is the credit risk. Okay, you analyze that. Based on that, you reassess, is what they're saying. Don't do it blindly as you've been doing before. Just reassess with the current information. Whatever current observable data you have, use that. Okay, give the effect of this into your provision matrix, and then accordingly, make provision is the simple answer. Okay, that's all. A simple data as such. Nothing fancy. Excuse me. Hope I don't have to read everything as such. Yes. Because we are not trying to cover full detailed way. I'm just giving you what you should know for your marks, because not everything will land up in your examination as such. Okay, they could hardly ask us 2 to 3 ka, because right now 2 marks and all questions are pretty rare, but don't know now if the institute decides to modify by any chance. Okay, so maybe if they decide to ask like that, then these sort of questions will have a preference as such. Let's find out. Even we don't know. Maybe due to COVID, who knows how it's going to shape out. Any which way, in order to sustain the economy in this period of depressed economic conditions, resulting from COVID-19 pandemic, the government and the Prudential Regulatory Authority of Banking Sector, RBI you could say, has advised financial institutions to grant loan repayment moratorium or payment holidays to its borrowers. This was a relief measure, right? Which banks told all their borrowers, right? You don't have to pay me the EMIs, monthly installment on your loan. Now we will give you, not waived off. Okay, we just deferred it. Next 3 months, you don't have to pay me the EMI. Later on, I'll recover that portion. Yes, this was given for across as a blanket rate to everybody, not to selected approach, selected customers, selected borrowers. To every borrower, this moratorium was given. Now the question, a financial institution is required to follow general approach. Stage 3 model we call it. Stage 1, financial assets that have not had significant increase in credit risk since initial recognition. Stage 2, financial assets that have significant increase in credit risk since initial recognition. And stage 3, financial assets, objective evidence of impairment. Full gyan they are giving. Okay, let's see what they're trying to ask. For recognition and measurement of impairment on its loan. Okay, to calculate impairment loss, no, they're following the stage 1, stage 2, stage 3. Who tells that stage 1, stage 2, stage 3? As per IND AS 109, sir. We have done. One moment before, okay, I'll read off this question. In the event the borrower requests and the financial institutions grants a loan moratorium, borrower tells I need some time, and that financial institution could be SBI or whoever, okay, if they give that moratorium to the customer, okay, does it result in stage 1 exposure move to stage 2? If simply they're asking if moratorium period is given, okay, then from stage 1 does that financial asset become a stage 2? From exposure from stage 1 will it go to stage 2? Stage 1 is no significant risk. Stage 2 is there is significant risk. Stage 3 is credit impaired. What are they trying to tell, sir? I will show you in the chart, sir. Wait, we have done this, okay, but good also to show. Wait. Here, you remember impairment of financial assets we covered in our financial instruments chart, point number 19. Okay, there to calculate impairment loss, one method was used. Do you remember? Expected credit loss method we used to take. IND AS 109 recommended expected credit loss method. To apply this method, you require something known as POD, probability of default. And we told what? There are two types of probability of default. Okay, one, if money is outstanding on financial assets for more than 30 days from the due date, then financial asset is credit impaired. If financial asset is credit impaired, then you have to take a lifetime probability of default percentage. If a financial asset is credit impaired, if there is a significant increase in credit risk, okay, then you have to take lifetime POD percentage. For all other financial assets, you will take 12 months POD percentage. This 12 months POD percentage, they are calling it as stage 1. This lifetime POD, they are calling it as stage 2. Okay. Stage 3 is Govinda, Tripti toss, full, patash. Okay. Alright, that is stage 3. That's what they are referring to as stage 1, stage 2. Okay. And how you find out that loss allowance, impairment loss, we also call it as loss allowance as per financial instruments, right? You take financial asset multiplied by POD percentage multiplied by probability of unrealized cash flow percentage. This question was based on the POD. What POD percentage should you take? Okay. So if banks give moratorium period, that payment EMI holiday period, okay, does that automatically mean this is credit impaired, and should we use lifetime POD percentage or can we use 12 months POD percentage is what they are indirectly trying to ask. Okay. No, you only tell, sir. Is it fair that just because banks give moratorium period, does it automatically become credit impaired? Now, loans, many of them would have taken loan. Yes. Let's say there is one person, he is working in a software company. Due to lockdown, what did the company tell him? You work from home. Okay. His salary was as it is, sir. He did not take any pay cut. In fact, he saved a lot. His traveling cost was reduced, his shopping cost came down, his many expenditures came down because they were only staying at house. Okay. In fact, like what? Salary was same. Expenditure in fact reduced, savings increased. Now this guy has taken a loan from SBI. Okay. Now can SBI tell, oh, okay, I've given moratorium period of 3 months to this guy. This financial, since SBI has given a loan, it's a financial asset. A contract to recover cash is a financial asset, correct? No. Yes. So can SBI tell, oh, I've given a loan to him and I've given moratorium period, hence this customer loan has become credit impaired. Not necessarily. Check how is there any increase in the credit exposure now? All right, he's doing good. His salary is the same. In fact, he's doing better than the pre-lockdown period. Yes, because of the savings and expenditure he's doing. Okay, so you can't take a blanket approach. You have to assess. Suppose you are given a loan to a company. Due to lockdown, it affected their business severely. Okay, you feel they're not able to come out of it. Even after the moratorium period, if you feel, the banks feel they'll not be able to recover the money, then you could tell, yes, there is a significant increase in credit risk. Okay, and then it moves from stage 1 to stage 2. You can call that. Okay, but you can't make a common statement just because you have given a moratorium period to everybody. You can't say there is increase in credit risk now and use lifetime POD. That approach is incorrect. That is what they have clarified in this question. That's all. Full of fancy terms. Actually, the question is pretty simple only. Full they try to make a little big deal out of it. So what is the final answer? So it is no. It does not automatically become that this is credit impaired. That is what they are saying. Okay. If you want maybe this one, I'll just quickly read it out for you. It is important to bear in mind that IND AS 109, like other IND AS, is a principle based standard. All the IND AS as such is a principle based standard. It is not rule based. Rule means you have to follow it. IND AS is a principle based approach, meaning there is a scope for your judgment. Okay. So that's what that's what they're saying. It's a principle based standard and requires application of management judgment in particular regarding credit risk management in ECL estimates of 109. ECL means expected credit loss method, we call it, as per 109. That's what they're saying. Therefore, prudential regulatory support measures such as temporary repayment of moratorium to tide over current situation should not be applied mechanically to classify financial instruments into stage 2 category requiring lifetime POD percentage. So just because you have given moratorium period does not mean it automatically moves to stage 2, that is credit impaired, and you have to apply POD, lifetime POD percentage. Not really so. You have to assess it on a case by case basis. That's what they're trying to say here. Check. This assessment should be made considering all information about past events, current conditions and future. Okay. Alright. If you want, this also we can read. As a guiding factor to retain this financial instruments in the existing category. If you want to keep that financial asset in stage 1 only, then entities should consider whether financial instruments where repayment moratoriums were given, because this was given as a blanket to everybody, were regular with no signs of credit deterioration. Just because you gave moratorium, his position or the borrower position did not come down. There was no big risk as such at the time of granting moratoriums, and whether these financial instruments are expected to remain regular during relief period and after. During the moratorium period also, his loan was, his position was same, it was fair only. Even after that, if banks feel, no, I'll be able to recover money from him, there is no significant increase in credit risk, then it will remain in stage 1 only, meaning 12 months ka POD percentage only. If you want, you will take. Okay, that is what they are saying. So extension of blanket financial support to all the borrowers in certain class does not automatically mean that all such borrowers have experienced significant increase in credit risk. Hence, evaluation should be done on other factors also. Case by case, you analyze is what they are saying. Okay, don't take a blanket approach. Don't say everything has come to stage 2 now. Don't do that. That is what they are telling you. Okay, getting tired. Me too. We'll finish off. It's okay. Yeah. So this is with respect to financial instruments. We covered that. Okay. Next, IND AS 113 fair value measurement. IND AS 113 fair value measurement. So 1 minute. I'll just show you our charts first. Then we will come to this. This one. See, these are our old class charts. If you just check, to find out fair value, there are 3 inputs or 3 levels of inputs. Level 1 inputs, level 2 inputs and level 3 inputs. Level 1 inputs are quoted market price. Yes. Level 2 are quoted market price of similar instruments. Level 3 are unobservable inputs. These 2 are observable inputs. Okay. And these are unobservable inputs as such. Okay. So this. Now, what the funda of, or why am I showing you all this is, okay. Now, for many assets, you need to find out fair value, correct? No? Many assets talks about, if you are following like financial instruments, it says, for financial assets, either you can go for FVT OCI or a FUTPL. There are certain conditions, obviously, yes. But what does that FVT OCI mean? Fair value through other comprehensive income. FVTPL means fair value through P&L. To value those instruments, obviously you require what? Fair value. So Ind AS 113 gives you a guidance as to how fair value should be determined. Okay. The golden principle or a thumb rule is use maximum amount of observable data. Level 1 and level 2 should be used as much as possible, alright, to the maximum extent. If level 1 and level 2 inputs are not at all available, then you can find out fair value using level 3, that is unobservable inputs. Basically, use maximum amount of observable data and use minimum amount of unobservable data. That is what a fair value measurement ka simple thumb rule is all about. Okay. Now coming back to this component, what are they trying to say here? Just 1 minute. Okay. Let us say there is a financial instrument. Okay. One company A Limited, they purchased equity shares of Reliance. A company A Limited, they purchased some maybe 1,000 shares of Reliance they purchased as an investment. For equity instruments, okay, you have two options. Either you can go for FVT OCI or FVTPL. Okay, you can't go for amortized cost method or ACM method because it fails if you test, if you remember. Yeah, all right. If you go for FVT OCI, that is what at the time of initial recognition, company has an option. Either they can go for FVT OCI, but that is irrevocable option. Meaning once you select FVT OCI, you cannot reclassify from FVT OCI to FVTPL. You can't shift the category because it is irrevocable. Okay. Or you can go for FVTPL. These are the two options. Okay. I'm relating to this case study. Let us say this A Limited, for those Reliance shares, they adopted FVTPL method, fair value through P&L account. Okay. That means this instruments will be valued at fair value. Okay. So any gain or loss, since you are following FVTPL method, any gain or loss will be going off to P&L only, profit and loss account. Yes. But due to COVID, stock markets and all were very volatile. The price was like, there was a huge movement. Okay. So the question that arose was, can I take the quoted price in the share market? Can I consider still those prices as level 1 inputs? Because now environment has become too uncertain, volatile. Even in this volatile environment, can I take quoted price in the stock exchange as level 1 inputs only was the question. Can I use that as level 1 inputs and still do the valuation of my investments using the same input was the question. They've reiterated that. Whether, though the share markets are volatile or uncertain, still they are level 1 inputs only. So if they are available, you will take it and you will value the investment using that only. So that's what I've written here. Quoted price are still level 1 inputs, even if the markets are highly volatile and uncertain. You will still take that only and value the investments. Okay, that there is no change. So gain or loss should still go into P&L only, even in volatile and uncertain times. Okay, that's the first pointer. Next, equity instruments measured at FVTPL, same. Okay. Now another issue was, okay, company, another clarification which companies was looking at. Okay, there is same, we'll say A Limited, they purchased shares of Reliance. Which method did they choose? FVTPL. But was that the only option for them? No, they could have gone for FVT OCI also or FVOCI also. But when they should have gone for it? At the time of initial recognition. When this A Limited buys Reliance shares, at that time only they need to decide. On initial recognition only, they need to decide whether they want to go for FVT OCI or FVTPL. Okay. Suppose they have gone for FVTPL. Companies went for FVTPL. Then now the question was arising is, can the company, due to this COVID environment, can the company change the valuation now? Can they move from FVTPL to FVT OCI now? Okay, now can they change? Was the question or some doubts which was there, which ICAI is again trying to classify. Once you have chosen FVTPL, okay, gain or loss should be booked in P&L. Because of COVID, reclassification to FVT OCI is not permitted. Reclassification to FVT OCI or showing the investment at cost. Another option, another doubt the company was having is, I'll show my investment at cost. Because if you remember AS 13, accounting standard 13, not IND AS, it used to show It used to classify investment as short-term investments and long-term investments. And long-term investments under AS 13 used to be valued at cost. Any temporary decline you used to ignore, permanent decline you used to provide for. That is as per accounting standard 13. So some companies were of the doubt that can I show these investments? Though I have elected FVTPL method as per Ind AS 109, can I still, because of this uncertainty in the economic environment, can I show that investments at cost? Clarification says no, still go for FVTPL method only. Investment at cost is very rare, sir. Only if you are not able to find out fair value. Okay, if you come to a conclusion that none of the inputs are available and if you are not able to find out fair value, then you can go for cost. So that's the reason I've just written here, investment at cost is not permitted, or rather it is permitted under a very rarest of rarest circumstance when fair value cannot be determined. Okay, this is the second clarification as such. Then if level 1 inputs are not available, because if the stock exchange in many countries, if at all it was closed due to too much of volatility, okay, you will not be able to figure out the you will not be able to figure out the fair value using level 1 and level 2 inputs. Yes. So if level 1 inputs are not there, then you go for level 3 inputs. Level 3 inputs are known as unobservable inputs. So if level 1 are missing, inputs are missing, then level 3 inputs can be used to find out the fair value as such. Okay, these are some clarification which they have given as per Ind AS on Ind AS 113 fair value measurement. Simple funda. If I have to tell, though there is uncertainty, quoted market price are still level 1, no change. Okay. And if you have chosen to measure in your financial asset using FVTPL method, then from FVTPL, now because of COVID, you can't go to FVT-OCI. Because to go to FVT-OCI for equity instruments, you should have made that choice on initially only. Now you can't change. So you can't move from FVTPL to FVT-OCI. Or you cannot show it at cost also. That is the second clarification. If level 1, level 2 inputs are missing, then level 3 inputs can be used to find out the fair value. These are 3 clarifications or 2 or 3 clarifications with respect to Ind AS 113 fair value measurement. I'll look at the questions. I think questions are pretty basic, same. Nonetheless, I think we can quickly run through. 1 minute. Yeah. Question number 10. Subsequent to the announcement of COVID-19 as global pandemic in the middle of March 2020, the financials and security markets have been highly volatile and uncertain. Okay, in such uncertain markets, whether quoted price can be considered to be reliable or meet the requirements of classification under level 1 as per Ind AS 113. Though volatile, they are still considered to be, quoted market price are still considered to be level 1 inputs itself. Unadjusted level 1 inputs basically are level 1 inputs only. So yes is the answer. That's what we read now only. Yep. Next, an entity has certain equity investments, financial assets, which are quoted in securities market. So quoted market price is available means we'll use that. Unadjusted market price means level 1 inputs. Yeah. Equity investment is classified as fair value through P&L. So the company has opted for FVTPL. There was an option to choose FVT-OCI because at the time of initial recognition, but that is irrevocable. But this company has not gone for FVT-OCI, they have gone for FVTPL. At the previous reporting date, the fair value measurement was classified under level 1. Since, level 1 inputs you have used. Okay. COVID outbreak is expected to have significant adverse effect on the future profitability of the issuer of these investments. Whose company ka shares you have purchased as investment, no? The COVID has caused adverse effect on such company, and because of that, your investment ka value they're saying will be significantly lower. The fair value basically has reduced is what they're saying. And therefore, no transaction in this security occurred during the month of March 2020. Security only banned it. Okay, matlab, transaction is not happening. Can this equity investment be now measured at cost? Now they're saying, can you measure it at cost model? Or reclassified through fair value through other comprehensive income, that is FVOCI or FVT-OCI. Further, if quoted price are not available, what would be the approach for determining the fair value? First, can we shift from FVTPL to, can you show it at cost? No. Can you show it at FVT-OCI? No. If quoted price is not available, meaning level 1, level 2 is not available, means what? Use level 3 inputs. Level 3 inputs are valuation techniques. We have done. I also showed you in the chart here. Yes. Use level 3 inputs, valuation techniques, to find out the fair value. That's what they're trying to tell here. That's it. Yeah. Next is on IND AS 115, revenue from contract with customer. Again, a huge standard which we spend quite a lot of time on. Few extra clarifications, pretty simple ones only, has been given with respect to that. Okay, let's cover one by one. First one is, if collectability issue arises, then no further. This is the guidance they've given. Okay, first we'll read the guidance, refer the old provision we have learned, and see if necessary apply it in one of the problems. If collectability issue arise, then no further revenue is recognized. However, past revenue recognized should not be reversed. This is the clarification they have given. Let's go one step back. There are about 5 steps in recognizing the revenue. These are old charts. Yes, if you just check. 5 steps. You remember the steps? First, finding out the contract. Second, finding out performance obligation. 3, finding out transaction price. 4th, allocate transaction price to the performance obligation. 5, recognize revenue when the performance obligation is satisfied. These are the 5 steps that is there in revenue recognition. Okay. Once these, when you enter into a contract, you analyze or you assess these 5 steps and then go ahead and recognize the revenue. Every time you need not assess the steps. On initial recognition of revenue, you assess this, and then only if the conditions change, then you will go for reassessment. Okay, if some event happens, like COVID in this scenario, or if customer is bankrupt, or some significant risk is increased, then you will reassess. Otherwise, you will not do these steps once again. Initially, you will do it, and accordingly go ahead and keep recognizing the revenue. Okay. Along with this, if you just check, there was also one more. If there is any uncertainty with respect to collection, okay, you can recognize the revenue only if there is no uncertainty with respect to revenue recognition. Okay, so if uncertainty has come in, means you cannot recognize the revenue. We had also studied that also. In fact, if we just check here on our others point, in point number 25 in our old chart, we had written, if collections from contract consideration is uncertain, meaning if collection is uncertain, okay, and part consideration is received, a customer has paid you an advance, let's say he has given some advance to you, okay, but now you feel he will not pay the balance money. Okay, if some uncertainty has come, then what you should do? Okay, what you should do for that advance received also we have covered. Can you recognize that advance received as an income? Yes, provided one of the 2 conditions is satisfied. 1, entity has no remaining performance obligation. All the performance obligation has been satisfied from entity's side. And 2, the consideration or the advance which the company has received from the customer should be more or less the full value of the contract. Should be substantial consideration received. Meaning almost full value of the consideration you should have received and non-refundable. These 2. 1, whatever performance obligation company had to satisfy, they have satisfied. 2 is the consideration or the advance which they have received is almost more or less equal to contract value, and that is non-refundable. Either that or the contract is terminated, meaning the contract is cancelled and the amount received is non-refundable. If one of these 2 conditions are there, then advance received, you will recognize it as revenue. Otherwise, you will not recognize it as revenue. That's the point we had written. The clarification is given now also on the same thing. If uncertainty has arisen, means you will go ahead, you will stop recognizing the revenue. Pastly, whatever you have recognized as revenue will not have an impact. If you are looking for an example, let's say A Limited has entered into contract with B Limited, that every month, like A Limited will sell goods to B. Month on month contract it is. January 2020, A Limited transferred the goods, B Limited paid the money. Okay, let's say it's 15 days credit or something. We'll keep it that way for simple thing. So January May, A Limited gave away the goods. Let's say performance obligation in this is satisfied at a point in time. Hope you remember. There are 2 ways in which performance obligations get satisfied. At a point in time, over a period of time. For simplicity, I have told you, at a point in time means like completed contract method. If you remember accounting standard 7 in your IPCC days. Yeah, it's like that. Over a period of time means it's a percentage of completion method. Okay, hopefully you guys remember it. Okay. So A Limited has transferred the control, has given the control over the goods, meaning performance obligation of these goods have been satisfied in January and B Limited has paid the money also. Since PO is satisfied, A Limited would have recognized the revenue on this. Okay. February month also, A Limited has transferred the control over the goods, meaning performance obligation is satisfied. Okay. So A Limited will recognize the revenue on this. Let's say B Limited has also paid the money for this February goods also. Assumption. Okay. The month of March, however, okay, A Limited has given the goods, okay, alright, but A Limited feels they will not be able to recover the money, okay, due to this COVID impact, okay. Now the question is, for this March 2020 goods, can A Limited recognize the revenue? There is a clarification. If A Limited, if the company feels that there is an uncertainty with respect to collection of the goods, okay, then don't recognize the revenue on it. Okay, but however, whatever revenue you have recognized previously, like A Limited has already recognized revenue in January, February, that you don't have to reverse. That is sorted. This month ka revenue you don't recognize because there is uncertainty revolving around it. That is what they are trying to say here. That's it. Simple. Easy? Believe it's easy only, yeah? Alright. Okay, let's do a thing. This one, no, we'll just take up cases also simultaneously. It might help us. Concept we learn and immediately we'll also just take up. There are about 4 to 5 cases with respect to revenue. Probably you have the largest number of cases with on India is 115 only with respect to case. Okay, we'll see. Question number 12. In days 115, revenue from contract with customer, para 9 requires entity to account for revenue contracts. That is, start recognizing in the financial statements only when the 5 conditions are satisfied. Just now we discussed those 5 conditions. Okay. One of the conditions, that is clause E of para 9, there is a clause, subclause it is, okay. One of the conditions ka subclause says, it is probable that the entity will collect the consideration to which it will be entitled in exchange for goods and service that will be transferred to the customer. Meaning, you will go ahead and recognize the revenue only if 5 steps are satisfied. One of the subclause of that 5 steps says there should not be any uncertainty in collection. The revenue which a company has to collect, there is no uncertainty, they will collect it is what they are trying to say. If there is an uncertainty, you should not recognize the revenue. In compliance with this condition, an entity has started recognizing the revenue from sale of goods contract from the beginning of financial year 1920. Okay. They've started recognizing the revenue because all the conditions were satisfied. And I told, we will not do assess the 5 steps every time. Okay. Once we'll assess and we'll go out and recognize the revenue. Only if things have changed, some uncertainty has come in or some external indicator has come in or some indicator is there, then only we'll reassess for those steps. Otherwise, we'll not do the reassessments. Now, due to COVID-19 outbreak, the customer has come into serious financial difficulties. Obviously, many companies had this problem, and this company, unfortunately, your customer is facing financial distress. And this liquidity scenario is likely to continue for another 12 months. He's saying it's not temporary. He will have this issue for another 12 months. Okay. Next, does the entity need to reassess this criteria? Criteria means 5 criteria, 5 steps we had. No, should we reassess that? Should we test for those steps again due to significant deterioration of customer's credit worthiness? Customer's credit worthiness has clearly changed. Hence, you need to reassess. Answer to this is very much yes, you do need to reassess. Meaning, you have to go through all the steps once again. Okay. What is the accounting for initial advance or part consideration that the entity has received from the customer whose credit worthiness has substantially deteriorated significantly? What is the treatment for advance you have given? Advance, what do? You can recognize provided one of the 2 conditions is satisfied. One, all the performance obligation is satisfied. Consideration received is almost equal to contract value and it is non-refundable. Either that or either contract is terminated, meaning cancelled, and the amount is non-refundable. If one of the 2 is there, means you can go ahead and recognize the revenue as such. That's what you will quote, and that is what they have told here as well. Alright, simple funda. Yeah, easy. Okay. Right, let's see this question number 13 also, we'll take it up. I think it's similar. An entity has a 3-year contract for supply of electricity power, 3-year contract to an industrial undertaking. Okay. In the view of expected manufacturing activity due to depressed economic conditions of COVID-19, The entity has accepted customer's request to reduce the electricity tariff. So due to this, the customer is told, reduce the kilowatt. Normally we charge it in kilowatt, right? Reduce that tariff of that units, as well as minimum quantity that will be taken over the remaining period of the contract. Maybe here the contract had, you have to buy these many kilowatts of power every month or every year. Like this, probably some stipulation was there in the contract. The customer now, due to COVID, has asked to reduce that minimum requirement, because obviously he will not be operating at full capacity, right? So he may not require so much of units of power, hence he is requesting, reduce the minimum quantity of power I need to purchase from you, and also reduce the price per unit also. Tariff also, you please reduce, is what the customer has requested. How the change, in fact the customer has requested and the entity has accepted also. Okay, entity has accepted the customer's request over there. So how should the change in the terms and conditions be accounted? Okay, got the question. This is not actually a new question. We have already covered this in Ind AS 115. Remember which concept is this? It is contract modification. I'll show you your old chart just to bring your memory back. Here, contract modifications. Remember, contract modification means what? Either changing the scope or price of the contract, or both. Alright, scope means new goods you have added, new distinct service you have added, anything like that if you have added, or price you changed, okay, or both you have changed. That's what we call it as contract modifications. Alright, the contract modification should be agreed by all the parties, it should be enforceable. Contract means it should be agreed by all the parties, correct? Now, accounting wise, if there is any contract modification, how you should do? There are two possible ways. Either it will be treated as a separate contract or no separate contract, meaning you will continue your accounting with existing contract only, or you will create a separate contract for it. If you want to create separate contract, there are two conditions for it. One, new goods or service should have come in. That's what we have written as plus goods or service. And if new goods and service has come in, means transaction price would have already increased. The increase in that transaction price or contract price should be commensurate, should be at par with standalone selling price of that additional goods or service. We have done enough problems with respect to this. If both of these conditions are satisfied, then you will treat this as a separate contract. If it is a separate contract, means you will do the new accounting for it. You will not touch the existing one. You will go ahead and recognize all the 5 steps. You will do it again and recognize it as a separate contract. If the conditions are not satisfied, then it will be treated as not a separate contract. If it is not a separate contract, either you will account it on a cumulative catch-up basis. Whatever revenue you have booked, you will kind of adjust that. That's what we call, the term we call it as cumulative catch-up basis. Or if it relates to distinct goods or service, then existing contract will be cancelled and new contract you will account it. We have seen problems based on this. That is not the funda here. Okay. Here there is some contract modification. This is a pointer we had written. Let's come back to our problem and just check. 1 minute. This one. Now 3 years contract was there to supply electricity to another customer. We told the customer you have to buy this much quantities of power and the rate I will give you is this much. Let's say we had told the customer you have to buy 1000 kilowatts of power every month, okay, and I will give you the rate at 10 per unit. For 1 unit of kilowatt of power, I will charge 10 rupees. Let's say that was the agreement we had with the customer. Now, due to COVID outbreak, customer has told, sorry boss, actually this was minimum, okay, we had told the customer minimum you have to buy 1000 kilowatts of power every month and we will charge 10 per unit. Customer has requested us, say, due to the lockdown and due to the capacity reduction, I will not be able to buy so much from you because there is no so much requirement. Kindly reduce it to 800 kilowatts. Okay, per month. And even the price 10 now looks a little high, make it as 8 per unit please. Okay, consider this. Okay, we felt it was a genuine request, okay, and due to COVID we accepted this. Okay, we said fine. Now first, is this a contract modification? Very much yes. Okay, scope has reduced, price is also reduced, yes or no? Okay, correct. So that means this is a contract modification. Now contract modification means either you will account it as a separate contract or not a separate contract. If you want to account it as a separate contract, we saw two conditions. One, new goods or services come. Has new goods or service come in here? No. And two, the increase in transaction price or contract price should be commensurate or should be at par with standalone selling price. Now, is there an increase or reduction here? This is a reduction. So, can you treat this as a separate contract? Absolutely no. The first case is what? It is not a separate. First, you will write it is a contract modification and write why it is a contract modification. Then you will write, you will say it cannot be accounted as a separate contract. Why? Because the two conditions are failing. So, I am just giving you a summary, small just notes here. It is not a separate contract because the two conditions are failing. Okay. If it is not a separate contract, we said we will do cumulative catch-up basis. We have done problems already. When will you do cumulative catch-up basis? If you had told the customer, retrospectively I will reduce the price. Retrospectively, meaning whatever previously you had purchased, previously you had purchased at 10 rupee, that price also I will make it at 8 rupees. If I had told, then you will do cumulative catch-up basis. Here, did we tell that? No. Here, check what is this. What did we tell the customer? Going forward, that's what they are saying here. Check. Yes, in the view of expected manufacturing facility, the entity has accepted request to reduce electricity tariff as well as minimum quantity that will be taken over the remaining, the keyword here is remaining, over the remaining period of contract. Whatever contract term is already passed, let's say 1 year is over, alright, that 1 year ka price also we are not reducing, minimum quantity also we are not reducing, that we are not touching at all. Going forward, we are saying from now onwards, we will reduce the minimum quantity, let's say to 800, we will also reduce the tariff, okay. Since you are now doing a retrospective adjustment, in our problems we have done, that was a retrospective adjustments, hence we have done cumulative catch-up basis accounting, meaning revenue we have adjusted. Here, what is the solution? One, it is not a separate contract, point number one, okay. Past whatever revenue you have recognized, you will not touch that because we are not doing a retrospective adjustment. So that means previous revenue recognized will be unaffected, will remain unaffected. You should not touch that. Okay. Going forward, you will recognize the revenue at the reduced price. Going forward, revenue at the revised terms. Okay. That is what. This is a short gist if you want it. Alright. That is what they have given here also. Alright. In the instant, both the case have not been met, which both the case new goods or service has not come. Therefore, it is not to be accounted as a separate contract, and the same shall be accounted for as a modification of the existing contract. Okay. In such a case, the future revenue, this is a keyword check, that's what we have written also. Future revenue will be recognized taking into consideration the reduced tariff and reduced minimum quantity. Revised term you will consider and recognize future revenue. No changes are to be done to the revenue already recorded. Previously, whatever revenue you have recorded, don't touch that because this is not a retrospective effect. If it was a retrospective, then we would have done it on a cumulative catch-up basis. Then previous revenue we had to modify or increase or decrease accordingly, whatever is the case. Basically reduce in this case. Okay. Hope you have got the distinction. Okay. Let's take up this. Question number 14. An entity engaged in wholesale distribution of electric equipments offers various price concession based on volume of purchase. They are giving volume discount. Okay, we have done these questions also. Yeah, many questions we have done. The price concessions are considered as variable considerations under Ind AS 115. Okay, and the entity estimates the amount of revenue recognition based on past experience. Okay. Can the entity continue to adjust its revenue recognition based on past experience, or do they need to review in the context of current and expected conditions during post COVID-19 era? So what are they trying to say here is, let's say there is a company A Limited. They are giving some terms to a particular customer. The term is, if you buy more than 1000 units, or rather, we'll take it as less than. If you buy less than 1000 units from me, I will provide the goods at 10 per unit. If you buy less than 1000 units from me, then I will give you each product at 10 rupees per unit. However, if you buy more than 1000 units, okay, less than or equal to 1000 will make it here, and up to 1000 units we will give 10 rupees per unit. We will sell each unit at 10 rupees. If you buy more than 1000 units from us, I will charge you 8 rupees per unit. This is the agreement we have given. Alright. So here, one of the steps to recognize revenue is finding out the transaction price. Is the transaction price fixed here or it is varying? It is obviously varying because we don't know. Correct? If the customer buys more than 1000 units, then we will get only 8 per unit revenue. If he buys less than 1000 per unit, we will get 10 per unit. So this is based on the customer's choice. No? Yes. So that means the transaction price is varying due to price concessions, etc., rebates, etc. Yeah. So this we call it as variable consideration. One of the simple fund of variable consideration. What is that? Can you consider variable consideration in your transaction price, or can you add variable consideration to your transaction price? Yes, provided it is highly probable that future may revenue recognized will not get reversed. Okay, that is what we had written in our charts. You can refer. You can consider variable recognition in transaction price provided revenue recognized will not get reversed in the foreseeable future. Yes, that's what the point is. So now they are saying, okay, this was the terms. So they had assessed that at the time of contract inception, they assessed how much A Limited would buy based on the historical data. This company, let's say this term was given to a customer known as B Limited. A Limited assessed based on historical data that how much B Limited would buy. Let's say B Limited previously, last 4-5 years, we've been transacting with B Limited. Last 4-5 years, he's buying more than 1000 units. Last 4-5 years continuously, he is buying more than 1000 units in a year. So based on that data, A Limited concluded that we have enough evidence to prove that yes, he will buy more than 1000 units this year also. That means they would have recognized the revenue at what price? Since B Limited is expected to buy more than 1000 units, we would have taken the rate as 8 per unit and we would have done the revenue recognition, whatever way that is. Yes. Now the question they're trying to ask is, okay, A Limited has freezed 8 rupees and they're recognizing the revenue. Now COVID came. In COVID environment also, can A Limited tell, I have already freezed 8 rupees. I will not change this. I will record the revenue at 8 only. Can they use that approach or should they reassess in COVID is what they're saying. Before COVID, yes, 8 per unit was justifiable because you had previous data. Now, if COVID has adversely affected B Limited ka business, do you think B Limited will still buy more than 1000 units, or there could be a possibility that he may buy less than 1000 units also? There could be a possibility, yes. That means reassessment has to be done here. Pre-COVID era mein what you have done, same thing you can't continue. Reassessment is a necessity. Correct? That's what they're saying here. The entity would need to re-estimate the volume of purchase by the customer and in turn estimated price concession offered when determining the amount of revenue. They need to basically re-estimate. They can't continue with what they've been doing because now COVID came in, so many things would have changed. That is the question, or that's the concept, or that's the first concept. Okay, 1 minute and just go back to there's another concept. Just go to that first. Okay, this is the first concept which we covered. Next one, significant financing component, SFC. If you remember what is SFC, okay. You remember what is SFC, we had written also. If you want, I can show you that chart as well. Excuse me, here, SFC, significant financing component. All right, it occurs only when the consideration on deferred consideration or on advance receipt. Benefit could be to the entity or to the customer. Revenue should be recognized if there is significant financing component SFC. Revenue should be recognized at cash selling price. Difference between the total consideration and cash minus CSP will be an interest component which will be transferred off to PRL. Okay, maybe some of you would have forgotten. Okay, let's just give you an example. Okay, A Limited wants to sell goods to B Limited. Okay. Normally the credit which we give is 30 days. Normally, A Limited gives a credit of 30 days to B Limited. Okay, let's say a normal prices, we'll call it as transaction price, is 100 rupees. For 30 days credit, A Limited charges 100 rupees per unit. This is the normal term. B Limited told, sorry boss, I can't pay within 30 days. I need 300 days. Give me 1 0. We only invented 0 now. Be a little liberal, it's okay. Okay, B Limited told, Macha, please give me 300 days. I can't pay within 30 days. A Limited told, okay, you are my macha, take it, no problem. Okay, I will make an exception to you. Take 300 days. You pay me after 300 days. But A Limited is also smart. Okay, he told, you have to pay me 120 rupees per unit. If you pay the money within 30 days, I will give you it 100 rupees per unit. But if you're paying me after 300 days, I will charge 120 per unit. Now, the question that arose was, see, all these are A Limited selling the goods. So, obviously, it's a revenue. The question that arose was, should we recognize the revenue at 120? A Limited, should they recognize the revenue at 120 per unit or 100 per unit? Okay, check. This was 120 per unit for how many days? 300 days. Yes. Alright, and this is for 30 days. Okay, since the transaction is happening beyond the normal credit terms, okay, so here obviously now A is also not Bakra. He's charging 120. Why? Because there is a delay in payment. Okay, since B is delaying the payment, he's asking 20 rupees extra. Yes, the 20 rupees extra is not normal revenue. IND AS 115 says it is a significant finance component, meaning it is not your normal revenue, it is actually your interest component. So don't book this as your normal revenue, show this as an interest component separately in P&L. Okay, these sort of contract we say has significant finance component, meaning A Limited is not just selling the goods to B Limited, he is also giving a finance arrangement. Because he's not recovering the money within 30 days, he's recovering the money after 300 days. That means he's also acting as a financier. So financier means banker. Obviously banker, when they give finance arrangement, they collect interest, right? So the interest component should be recognized separately. That was your SFC. And we also had read about conditions where there is no SFC. There is no SFC in the following conditions. We had done all the many cases based on each of them. One specific point that is relevant for today's session is this one. There was a practical expedient available. Practical expedient means shortcut. Practical shortcut was given to customers. What they said was, if the time period, if the time gap between the date you transfer the control of goods and services, the day you transfer goods or service, take that date and take the date which you have received the payment, the day you have transferred the control of goods and services, and the day you have recovered the money. If that time period or that time gap, if it is less than or equal to 12 months, okay, then we say there is no significant financing component. From the day you transfer the control of goods till the day you recover the money, if that gap is less than or equal to 12 months, then one shortcut was given saying you don't have to think that if its period is less than 12 months, think that this contract has no significant financing component, meaning you don't have to find out this interest component. There is a small calculations also to find out interest component. We have done it in a couple of problems. Yes. So you don't have to do that. You can use this practical shortcut, which we call it as practical expedient. Okay. This one clarification has been given with respect to this now. Okay. Hope this is clear. Now let's come back to that. Now what has happened here is, let us say, we'll take it as A and B only. A Limited has given a credit period of 9 months to B Limited. A Limited has given a credit, A Limited has sold the goods to B Limited, and A Limited has given a credit of 9 months. Now, there is a practical expedient available in IND AS 115. What does it say? If from the day you transfer the control of the goods till the day you recover the money, if that gap, if that difference is less than 12 months, less than or equal to 12 months, then you can think that the contractor does not have significant finance component. You don't have to break your head to find out the interest and all. Okay. Since this was 9 months, let's say A Limited used a practical expedient. So they did not find out any interest. They were doing the recognition normally. Okay. Now, due to COVID, things were okay. It's fine. Now COVID came and B Limited told, look boss, becoming a little difficult. Okay. I'll not be able to make the payment within 9 months. Please give me 5 months extra credit. We had already given 9 months credit. Okay, now B Limited is saying, I need 5 months extra credit now. Now you just check. 9 months initially given plus 5 months extra. How much it has become? 14 months. Is this period greater than 12 months? Very much yes. So can we use practical expedient literally? No. Okay. So here there was a little bit of janjat. What should we do in this cases? Should we still treat these contracts as no SFC contracts, or should we now come to an assessment that no, this contract has SFC and find out that interest element? There was a small hiccup or confusion regarding that, which ICAI is trying to clarify that. Okay, let's read through that. No SFC. heading, you know the answer already. Okay, no SFC, that is the answer. All right, let's see. No SFC when? There are certain conditions. One, extra credit is given to the customer due to COVID-19. That's what we told here, no, 5 months. Extra credit is given to the customer. Initial credit period, in our example, initial credit period was 9 months plus extra credit period, which is 5 months. It should be greater than 12 months. Is it? Yes. 9 plus 5 is 14 months, which is obviously greater than 12 months. You have given extra credit, initial credit plus extra credit, if you add, it is greater than 12 months. Third one is very important. Check the transaction price. If transaction price is not changed, then this contract does not have SFC. Meaning, let's say when A Limited sold the goods to B Limited at 9 months credit, no, let's say the price was 100 rupees. A Limited sold the goods with 9 months credit to B Limited. The price was 100. Now A Limited gave extra credit 40. Now the total credit is 14 months. Let's say transaction price is still 100. Meaning just because extra credit was given, A Limited did not charge extra money. He's charging same amount. If this is the case, means if the transaction price is unaltered, if it is unchanged, then the contract has no significant financing component. If transaction price has changed substantially, let's say from 100 became 120 or 130, then yes, the contracts have significant financing component. So 3 conditions. 1, extra credit is given. 2, original credit plus extra credit is more than 12 months. 3, most important one, check if transaction price is same or changed. If it is same, meaning if it is not changed, then the contract does not have any significant financing component, meaning no SFC. However, if transaction price has changed significantly, then those contracts will have SFC. That is the pointer here. All right. Okay. If you want to look through the questions and just show it to you, 1 minute. Question 15. An entity is engaged in the manufacture and sale of heavy commercial vehicles, offered 6 months credit. So initially we were giving him 6 months credit, interest-free credit. We did not charge anything extra. In the view of free credit period being less than 12 months, the entity has assessed that there is no financing component. They treat it as no SFC because it is less than 12 months, because practical expedient is there. In the arrangement based on the practical expedient, meaning shortcut as per IND AS 115. Now, in order to felicitate its customers to tide over liquidity crunch, okay, everybody is having any cash problem, to help them come out of that cash crunch, entity has decided to extend the interest-free credit for the existing completed contract by another 8 months. We already had given 6 months. Now we added another 8 months. That means the total contract period is 14 months. Obviously now the period is more than 12 months. That is a total of 14 months. Okay. Does this trigger the application of requirement to segregate significant financing component? Meaning now they're asking, should we recognize SFC? No SFC if transaction price is unchanged. SFC is there if transaction price has been changed. Have they anywhere told here to increase the transaction price? No. If nothing has been given, what do you say? You will write, assuming that the transaction price has not changed, this contract does not have significant financing component. That's what you will write and conclude. Okay. That's it. It's the same thing what we did here. No, not a problem as such. Okay. Next one we will go. An entity has entered into a contract to manufacture a generator to a customer before the lockdown period caused by, or actually one moment, hang on, we'll just read the concept first and then maybe we're going to come to that question. Actually here, this is the concept. Actually one more guidance notice. This is actual guidance note given with respect to this. Performance obligation satisfied at a point in time and goods was not sent to the customers, then don't recognize the revenue. This is the guidance. However, if delivery has been delayed at buyer's request, we have already seen the problems also based on this, then you can go ahead and recognize the revenue. What are they trying to say? Let us say there is a television manufacturer, TV manufacturer. There is a company who manufacture TV. They manufacture and they sell it. They sell the goods, this TV to a particular guy. What that person does is he inspects the TV, gives his approval. Okay, that's what you do. All right, you manufacture the TV and you give it to him. He'll inspect it and he'll give his approval. All right. So that means now, can you tell me how is the performance obligation getting satisfied? Performance obligation can be satisfied over two terms. One, at a point in time or over a period of time. At a point in time means at one shot. Over a period of time means over many periods as such. All right. Now check what is happening here. This company, let's say this is X Limited. They manufacture a TV and they give it and they sell it. Let's say they sell it to Y Limited. They deliver it to Y Limited. Y Limited will inspect it and then only take the after delivery he'll inspect it and then he will say okay. That means here, when will the control of these goods be transferred? It is for over a period of time. There was many conditions, so I'll just not go into that. Again, you can have your charts, you can refer to that. Okay, here when will the control get transferred here? Y Limited will get the control of the goods only when it is given to him. Yes, no. Once it reaches his premises, he will inspect it. That is when Y Limited will give the expectance, meaning the performance obligation will be satisfied once when Y Limited accepts it, inspects and accepts. Correct? That's when the performance obligation gets satisfied. Correct? That is what we mean by at a point in time. Now, let's say this TV was ready. On 20th March 2020, this TV was manufactured, it was ready for dispatch. We had to dispatch. But before we dispatched, there was a lockdown. Lockdown was imposed in the country. Because of lockdown, we were not able to, this company X Limited, they were not able to dispatch this TV to Y Limited because of lockdown restrictions. Now the question is, these goods are ready for dispatch. Should X Limited recognize the revenue on these TV because they were ready for dispatch, or should they not recognize the revenue? That was the question. That's the pointer we have written here. If performance obligation is getting satisfied at a point in time, okay, only when the customer gets the goods, he gets the control. He receives the goods only when he'll get the control over the goods. And goods was not sent to customer, then you can't recognize the revenue. Obviously here, performance obligation will only be satisfied. See, simple funda of revenue recognition is what? You will recognize the revenue when performance obligation is satisfied. When is the PO getting satisfied here? When the goods reaches Y Limited and he gives his acceptance. That is when you can say performance obligation is satisfied. Has the goods reached or it is still there in your factory? It may be ready, but has performance obligation satisfied? No. Then you cannot recognize the revenue. That is the pointer we have written here. As simple as that. Okay. Something we have written in different inks. If, however, if we modify the scenario slightly and say if goods was ready for dispatch, check here. If delivery is delayed at buyer's request, then you can recognize the revenue. This is not actually an extra. We have already done problem also based on this. Yes. Now modifying the scenario. Okay. Goods was ready for dispatch. Y Limited only came to X Limited ka premises. Y Limited ka representative came to X Limited premises. He said he inspected the goods. TV, he made an inspection. And he said, things are good. Alright, I accept it. But send the goods after 1 month for me, or send the goods after 2 months for me. I don't have space right now. I have a lot of consignments lying in my factory. Have some storage problem. Okay. You store the goods in your factory only. After 1 or 2 months, I'll take the goods or you dispatch it to me. Okay. The goods are fine. I accept it, but you send me the goods after 1 month. Okay. That's what Y Limited has told X Limited. Now in this scenario, can X Limited recognize the revenue? Very much yes. Why? Goods performance obligation is already satisfied because Y Limited has given the acceptance. But delivery of the goods we have delayed. Who has delayed? X Limited. But delivery, why is it delayed? Because of customer's request. That means control has been transferred to Y Limited. We are just the storekeepers. Okay. Maybe in these cases, what will X Limited tell? If you have to store the goods, means you have to give storage cost. You have to pay insurance of those goods and all. Correct? No, because if something happens to those goods, it'll be a little problem for X also. No? So generally in these sort of agreements, X Limited will ask Y Limited to give some storage cost to cover the insurance charges and all that. Yes. But simple funda is, if delivery has been delayed at buyer's request, then you will go ahead and recognize the revenue. Okay. That is the concept. Next question is just based on that concept. We'll quickly run through them. Okay, I think this one only. An entity, question number 16. An entity has entered into a contract to manufacture a generator for a customer before the lockdown period, caused by an unprecedented outbreak of COVID-19. Okay. The generator is designed and manufactured to customer's specification. Customer is giving the specifics and accordingly we are manufacturing. Generally, entities transfers the control of the goods sold to the customers and recognize the revenue on dispatch. The moment the goods are dispatched from the factory, okay, once the transportation bill is raised, all right, we say the performance obligation is satisfied and we recognize the revenue. That's what they are saying, okay. In the view of social distancing norms imposed by the government, the entity could not dispatch the goods. When will the performance obligation get satisfied? Once the goods are dispatched. That's what they're telling here. Okay. Did we dispatch the goods here? No. The reason could be anything. Lockdown, COVID, doesn't matter. Is performance obligation satisfied here? No. If PO is not satisfied, can you go ahead and recognize the revenue? Absolutely no. In such a situation, can entity recognize sales revenue? No. For the item ready for dispatch, it may be ready for dispatch, but PO will get satisfied only when you dispatch it, and dispatch has not happened, hence revenue will not get recognized. That's all as a straight answer. Okay, these two questions are based on small concept. I'll show you that concept first, then we will take that up. You remember, this is our old chart we'd written. You remember there was something known as contract cost. Contract cost were of two types: contract acquisition cost and contract fulfillment cost. Contract acquisition means, so if you have to get the contract, sometimes you may take the help of broker, or you'll set a target to the sales team. Get me that contract, I will give you this much bonus. Okay, so those are known as contract acquisition cost. That's commission, bonus given on target, sales target, etc. So what was the provision of Ind AS 115 said? Contract acquisition cost, if it is incremental means if it is directly related to the contract, meaning if contract is there means this cost also will be there. If contract is not there, then this cost also will not be there. Such cost we call it as incremental. Okay, if it is incremental, if these costs are incremental and if these costs are expected to be recovered, if the company will recover this cost from somebody else, if both the conditions are satisfied, then such contract cost can be recognized as an asset as per Ind AS 115. Ind AS 115 said contract acquisition cost can be recognized as an asset provided these two criteria are satisfied. Okay, same goes for fulfillment cost also. If you have let's say there is a contractor, he builds a building. Okay, there is one company, a real estate company, they have approached a contractor, Mestri, engineer, and told the engineer, hey, you construct this building for me. Alright. Now building, can you complete it off within 1 or 2 months, sir? If it's office building, let's say with a 10-floor building, can you complete it off so soon? No, it might take 2 to 3 years, if not more. Yes. So can you, to construct that building, won't you require some materials? Obviously, you require materials, you require labor, some activities you will also outsource it to subcontractors, correct? Those costs we call it as contract fulfillment cost. To fulfill or to satisfy the contract, we have to incur certain cost. Like to build this building, we have to incur some cost. Later on we'll recover it. But these costs we are incurring to satisfy the contract. Such cost we call it as contract fulfillment cost. If there is contract fulfillment cost, Ind AS 115 said, what did it say? First you check, is this cost covered under other standard? Other standard means Ind AS 16, property, plant and equipment, Ind AS 38, intangible assets, etc. Check if these costs are covered there. Okay, if these costs are covered there, then do the accounting as per that Ind AS only. If Ind AS 16 talks about it, then you do what Ind AS 16 only tells. You don't have to come here. If, however, if they have not covered under those standards, then check. First, if it is DAC means directly attributable cost. If it is direct, check these costs if it is directly related to contract. 1. 2. Check if these costs are expected to be recovered. Alright. 3. Because of this cost, check whether the asset that you used to satisfy performance obligations are getting enhanced. If all these conditions are satisfied, then as per Ind AS 115, even contract fulfillment cost, you can recognize it as an asset. So if you have to tell in a nutshell, what is it? Contract acquisition cost and contract fulfillment cost. Both can be recognized as asset under Ind AS 115. However, if the period of contract itself is less than 12 months. See, if you have recognized as an asset means you will amortize it over a period of time. If contract period is 3 years, you will amortize this asset over 3 years. Suppose contract term is itself is 1 year means what do you do? Is there any point in recognizing that asset? No, because you will amortize it off within 1 year only. That is what is the last point we have written here. If amortization period of the asset is less than 1 year, meaning if the contract term itself is less than 1 year, then that all these costs, you don't have to do so much drama. Everything will anyway go off to P&L. Okay. So this is the recap of what we have done, not the new concept. Okay. Now there is some guidance Institute has given with respect to these contract acquisition cost and contract fulfillment cost. Alright. This is a background. Let's see what that guidance is all about first. Okay. Contract fulfillment cost. What guidance they have given first check. Contract fulfillment cost. If it satisfies the criteria of IND AS 115, then what do? It will be recognized as an asset, correct? That's the first point. Already recognized as an asset as per IND AS 115. Conditions are satisfied, so you have recognized as an asset. Okay. Point number 1. Contract is cancelled. Okay. There is some contract fulfillment cost. Alright. Like same engineer example. Engineer is building a building. A company, real estate company has approached the engineer to construct a building. Okay. So he incurred certain fulfillment cost. He hired some laborers. Okay. He started paying salary to them. Obviously, engineer later will recover that money. Engineer, architect, whoever is it, will recover that money. Since the contract period was more than 1 year, he thought that building construction will take about 3 years. Since the period was more than 1 year, and since conditions of IND AS 115 are also getting satisfied, he recognized those costs as contract fulfillment cost and recognized them as an asset. Okay. Now, due to COVID, real estate companies, hospitality industries and all faced a huge problem. Yes. Alright. Let's say the contract got cancelled. The real estate company told, sorry boss, now I don't have money to pay you to complete that construction, nor the buyers will pay. I'll not be able to find the buyers also if we construct. So let's cancel the contract. This is what happened. Okay, this scenario. Now the question that arose was, this guy, the engineer, has already recognized that as an asset. Can he still continue to show that asset, or what he should do was the question mark that was raised. On that they are addressing this. Okay. So asset is already recognized and due to COVID the contract is cancelled. Now what do you do is simple thing. You don't have to break your head. Asset, no. Alright. Check. This becomes an impairment indicator for you. Check if there is any impairment loss. How there is an impairment loss? Let's say the engineer has recognized this as an asset. The carrying amount of that asset recognized is, let's say, 1 lakh rupees. Okay. In the real estate company told, sorry boss, I'll not be able to pay a single penny to you. I have many contracts. I have literally no money. All my units are unsold. I'll not be able to pay one rupee also to you. Engineer has already spent 1 lakh and he has shown this as a contract asset. Now you just check. This is an asset, right? Carrying amount of that asset is 1 lakh. Find out the recoverable value of that amount. How much is the recoverable value of that amount here? 0, because he is not able to recover anything. If carrying amount of the asset is greater than recoverable amount, you will obviously book something known as impairment loss. In this case, impairment loss will be accounted. If recoverable amount is not 0, but if it is 1 lakh, then impairment loss is 0. That's what, like that. Alright. So that's what they have given the guidance on. Fine. So if impairment loss should be recognized if carrying amount is greater than recoverable amount. Check is an impairment indicator. Basically, they're saying you can show that asset, but check if you have to impair that asset by any chance. Okay. Basically, by finding out the recoverable value of that amount. That's it. This is the first pointer with respect to contract fulfillment cost. Second one, same contract acquisition cost or fulfillment cost ka amortization. Normally asset is there means you will amortize it. Yes. If contract term is 3 years, you will amortize it over 3 years. Now, giving you a small example. Let's say we had a contract for 5 years. There was a contract. Let's say an event. We have expos, no? This expo, that's expo, mega expo, so many expos we have, right? So let's say we have a contract. We won a contract that we will be hosting that expo, okay, for about 5 years, okay? Technological expo, something we are hosting, yeah? For 5 years, we have got the contract. To fulfill that contract, obviously, we will also incur many costs, contract acquisition cost, contract fulfillment cost and all, many costs we will have to incur. Since the contract term is more than 1 year, and since other conditions of IND AS 115 was satisfied, we recognized it as an asset. Okay. Expo will run that, every year Expo will run, it will run for over 5 years, or once in 2 years Expo runs, something like that we can, or maybe we'll keep this as once in 2 years wala Expo. Okay, we won that contract. We have already recognized it as an asset. Now due to COVID, okay, that Expo got cancelled. Or let's say the term of the Expo, the customer told, okay, let's say the term was 5 years, now the term got reduced to 3 years. Initially the term was, the contract term was 5 years. We had won the contract for 5 years. Now the customer told, no, we will only do it for 3 years. Let's cut it short. We'll not be able to sustain. Now what you should do, because contract cost you will amortize, no? Will you still amortize it over the original contract period of 5 years, or will you amortize it over the revised term of 2 years? Was it really guidance required on this? Same, no, we have done these cases indirectly. What if the useful life of property, plant and equipment, if it reduces, what do? Obviously over the revised term, you have to re-estimate useful life every year. Yes, same goes here only. That's what they have given here also. Check. If contract term changes due to COVID-19, then contract acquisition or fulfillment cost, already recognized as an asset as per Ind AS 115, should be amortized over the revised term. Originally contract term may be 5 years, but due to COVID, if the term has been reduced, let's say it came to 2 years, then you will amortize it over the revised term of 2 years only. And also, since you have an asset, this could be considered as an impairment indicator. You will also book an impairment loss if carrying amount is greater than recoverable amount. These are the two guidance notes they have given with respect to the contract acquisition and fulfillment cost. Maybe we can just quickly look at the problem also, so that we'll get a little better understanding maybe. Question number 17. An entity engaged in the event management business, okay, they are in that business, had a contract for a mega cultural event in March 2020. So they had won a contract. The entity recognizes the revenue for such contracts at a point in time. They're saying performance obligation is getting satisfied at a point in time, and it incurs certain cost to fulfill the contract. So there's some fulfillment cost. These costs incurred to fulfill the contract are not covered by other Ind AS, and in compliance with the requirement of Ind AS 115, entity recognizes these costs as asset. So they have already been recognized as an asset. Following the government's preventive measure to contain the spread of COVID-19, the planned mega cultural event could not be held. It got cancelled. The customer has cancelled the contract. How should such contract cost be accounted now? We have already recognized the contract cost now. The term is not reduced here. Here the contract itself is cancelled. Impairment indicator. Find out the recoverable value. If carrying amount is greater than recoverable value, then book impairment loss. Otherwise, no need for any impairment loss. That is what they're saying here. Okay, impairment loss should be recognized if carrying amount is greater than the recoverable value. That's the short answer, which I've underlined here. Next question. An entity engaged in the provision of IT and data management service. So they're giving IT services. They have already incurred certain costs to obtain the new contract, to get the new contract. That means these are contract acquisition cost. These costs fulfill the criteria of incremental cost of obtaining the contract with the customer, and entity has recognized these costs as per para 9193 of Ind AS 115. Meaning they are saying they are recognized as an asset indirectly. That's what they're saying. Since you recognize these as an assets, you will amortize it. Okay, these were amortized in a systematic manner in accordance with Ind AS 115 over the contract term basically. Yes. Now, due to the onset of COVID-19, is there any change in methodology of accounting these costs? Very much yes. If due to COVID-19, if the contract term has been reduced, then amortization period also will get reduced. Earlier, if you are amortizing it over 5 years, and now if the period has become 2 years, means you will amortize it over the revised term of 2 years only. So answer is very much yes. Amortization life would have changed. Okay. That is with respect to Ind AS 115 revenue. That's about it. No, only for this standard, that's about it. Something else, other standards are also there. Simple ones only, don't worry. Other concepts are very, very straightforward. Okay, if you actually know the chart, in fact, we may not do the questions. Question automatically will be answered. Yeah, maybe if you're tired, if you want to do it that way, we can keep it. Okay, well, anyway, quickly run through them. We'll finish off. I would like to finish off this in this session itself. Okay, Ind AS 12 income tax. Now there is one specific provision here with respect to deferred tax liability. All right. Now, if you have an investment in associate, subsidiary, joint venture, should we recognize DTA, DTL on them was one question. All right. If you remember the chart, we made a chart for this. Chart ka contents I've already brought in here. DTL was not created on investment in subsidiary. If you have made an investment in subsidiary, on that investment, we would not have created DTL rather, because of two conditions. What are those two conditions? One, because parent has control over subsidiary. Two, difference not expected to get reversed in foreseeable future. See, deferred tax, or when will DTL come? Since this is an investment we're talking about asset. We had an equation, remember? If carrying amount of the asset is greater than the tax base, then only we create something known as deferred tax liability. Alright. So now, when you made an investment in subsidiary, let's say you made an investment at 100 rupees. You bought an investment at 100 rupees. Okay. Carrying amount is also 100. Tax base is also 100. This is initial. Now, let's say subsidiary made a profit. If subsidiary made a profit means it's a good thing for you, no? Yes, because you have control over their assets. So that means value of this investment also will increase. That will become how much? Let's say subsidiary made a profit of 20 rupees. You know this already. Yes. Net assets can be computed in two ways. Either assets minus liability or simply shareholder funds. Yes, shareholder equity, if you consider that itself will become your net assets. Yes. So if subsidiary makes a profit, let's say subsidiary made a profit of 20 rupees, then your investment value, if you're measuring it at FETPL, investment will become how much? 120. But tax base will be still 100 only. Carrying amount is 120, tax base is 100. That means there is a difference of 20. On this difference, we used to not create deferred tax liability. Why? Because one, parent has control over subsidiary. Meaning, now just check. Why we asked not to create deferred tax liabilities? See, this difference, it will get reversed. When will it get reversed? When subsidiary makes the profit, or let's say subsidiary after making the profit, if they give away dividend, they made 20 rupees profit, right? Entire 20 rupees profit, if they distribute as dividend, what will happen? If they distribute, cash balance will reduce. That means what will happen to your asset balance? That will also reduce. So if dividend is paid, if subsidiary pays the dividend, then carrying amount will become 100. Tax base will still become 100. That means this difference will get reversed out. Yes. So the difference will get reversed only when subsidiary pays the dividend. Yes. But whether subsidiary pays dividend or not, who will decide? Parent only, because parent has control over subsidiary. Since parent has control over subsidiary, okay, and if difference is not expected to get reversed, then no point in creating DTL, because see, DTA, DTL and all, you create a temporary difference. Though in Ind AS there is no permanent temporary difference wording and all, concept is still the same. They have to get reversed out. Here in this case, if parent feels, no, I will not collect the dividend from subsidiary at all, I'll keep it as it is, then this DTL, if you create, it will go on accumulating. It will chuma show it in balance sheet as such. Hence the standard said, don't create DTL. Okay, this is our old provision. That's what I've written here. But now the guidance is, now due to COVID, everybody is having cash crunch, correct? No. Now parent thinks, no, subsidiary. Till now I used to keep the dividend, the profit that you made, you never used to distribute as dividend to me because I had no requirement, meaning the parent had no requirement. Now due to COVID, if parent wants the money, meaning if subsidiary company is planning to distribute dividend, if company is planning to pay dividend, means the difference will get reversed out. If that is the case, means check, then DTL creation is a must, meaning DTL has to be created. That's what we have written here. Now due to COVID-19, if subsidiary company is planning to declare dividend, then deferred tax liability. Deferred tax liability, we don't create DTA, DTL on difference, right? We have to create it on taxable difference. We have to take tax rate. Let's say if the tax rate is 30%, 20 into 30% is about 6. Yeah. So we'll create a DTL for about 6 rupees here. That way. Okay, because carrying amount is greater than tax base. Okay, that is a clarification given with respect to the, you could say, income tax, Ind AS 12 income tax. Yes, this is a straightforward question. Same is there in the question that you can go through. Nothing much as such, not really that important. Okay. Okay, next one. This could be taken as important. Next clarification is on IND AS 37, provision, contingent asset, contingent liability. In this specific comment has been given on restructuring. Before we go into the restructuring, I would like to show you the old chart which we made for restructuring. If you remember, if company is making any restructuring, okay, if company has any restructuring activity, in IND AS 37, the question was, should we create a provision for restructuring activities? Was the question. IND AS 37, provision, contingent liabilities, contingent asset, gave some guidance. They said, provision for restructuring can be made provided two conditions are satisfied. One, organization should be committed for restructuring. Alright, and when can you say organization or company is committed for restructuring? Rather, when two conditions are satisfied. One, the company or the board of directors should have made a detailed formal plan of restructuring. What is the restructuring plan? They should have made it. Like restructuring plan means like which business is affected. Due to restructuring, they may close down a particular division. If they have 10 locations, they may decide to close down operations in one division. So you need to call down which part of business is affected, which location is affected, who are the employees affected, what is the total cost of the restructuring, etc. All this they should have made a formal plan. And that plan should be either communicated. Whoever is affected, let's say we plan as part of restructuring plan, we decide to fire 1,000 employees. Okay, we have made a plan to fire 1,000 employees. Now, you can say that organization is committed to restructuring, one, when detailed formal plan is made. In this case, very much yes. If the company communicates that plan to employees, company goes to the employees and says, look boss, in the next 2 months, you may be fired. So if either they should have communicated the plan or they should have implemented the plan, meaning constructive obligation they must have created or raised a valid expectation in the minds of users. That's what we call it as constructive obligation. And when will constructive obligation come? Either when the plan is implemented or if the plan is communicated. If these two conditions are satisfied, then you can go ahead and recognize provision for restructuring activity. This was existing provision for restructuring. Okay. All right. This is a recap of what we have. Now coming back to the clarification. Now what is happening here is, see, now due to COVID scenario, most of the companies are doing restructuring, either in terms of firing the plan or closing down few divisions. Like this, many people are doing restructuring. Now the issue was, let's say restructuring plan, let's say the financial year is 31st March 2020 is the financial year. Okay, but in the month of March it was lockdown. Okay, let's say lockdown opened in a particular country, and let's say this is A Limited, they were able to open or resume work from June. On June, board of directors met. They had a meeting, they met there, and they made a plan. They made a restructuring plan, we'll call it. They made a restructuring plan. Okay, to fire so and so employees, detailed plan they made. What and all is the restructuring activities needs to be done. They made a plan. Okay, the plan was made in June, or let's say we'll modify this date as 30th June 2020. On this particular day, board of directors made a plan. This financial year ended on 31st March. Let's say these financial statements approved. This year ka financial statements was approved on 1st August 2020. These financial statements were approved on August. Now the question is, they made a formal plan already. Plan was made on 30th June. Should we make provision for restructuring on 31st March 2020 itself, or should we make it in the next year? Question was that. Okay. Board of directors met after the balance sheet date. But they made the plan, but the plan was made before the approval of financial statements. Okay. Now the question was, should we treat this as adjusting event and make provision for restructuring on 31st March 2020 only, or should we treat it as non-adjusting event and just give a disclosure? Was the question mark, which they have addressed. That's what I've written here. We'll read through this once. Provision for restructuring should not be made. You should not create provision for restructuring when? If restructuring plan is either drafted, implemented or communicated. See, to make restructuring provision, two conditions are satisfied. Should be satisfied. One, detailed plan should be made. Two, that plan should be either implemented or communicated. If one of these, if both are satisfied, then you will make provision. Okay. So if either drafting, implementing or communication, if either one of this has happened after balance sheet date, okay, if it has happened after reporting date, meaning 31st March, then you don't create provision for restructuring, meaning conditions was not existing on balance sheet date. That means this is non-adjusting event, and this all just will be generally material items. So hence a disclosure will be given of this as per Ind AS 10, treating this as non-adjusting event. That's all. That is one provision. Okay. All right. Second one is no provision for future operating loss. This we know already. We have written in our old charts also. For future operating losses and all, you can't create provision unless the contract is onerous in nature. For onerous contract, you can make provision. We have worked out a couple of problems also based on onerous contracts. Future operating losses, no provision should be made as such. Okay. If you're looking at the question, maybe we'll quickly run through the question also. Okay, and question number 19. An entity engaged in automobile sector has assessed the impact of COVID-19 outbreak on its future viability of business model. Senior management has identified the need for restructuring some of its business activities. They've identified, they have not yet made the plan, okay? And retrenching, meaning firing off their employees in the many areas. Senior management is drawing up, not yet made, is drawing up a plan for consideration of board of directors in their meeting scheduled in May 2020. They're coming up with a plan and they want to give that plan to, they want to present that plan in board of directors meeting. And when will that meeting happen? May 2020. However, which is subsequent to the reporting date of current financial year. Current financial year ends on 31st March. So, can the entity recognize provision for restructuring cost? Absolutely no. Why? If for you to recognize restructuring plan, that plan must be, the plan, detailed formal plan must be made before balance sheet date. Okay. It should be either made, implemented. Basically, like, here all the implementation, drafting and all is happening after 31st March. So, clear guidance says you don't make any provision for restructuring. You just disclose that restructuring plan. Okay. Next question is on future operating loss, guys. Entity is exploring the possibility of recognizing certain amount of operating loss of provision. Future operating loss, can you recognize as provision as the next question? That's what the provision we read also. You can't recognize. This was existing. There's no guidance was really required on this because we already had this before only. You can't make provision for future operating losses because the definition of provision does not get satisfied there. If you remember the provision of definition, okay, it should be based on past event. There are 4 conditions for provision. One of the condition is present obligation arising out of past event. Okay, yes, which results in probable outflow of economic resources. Yes, so future for we make provision only for past events, not for future events. Hence, answer is straight away no there. Let's come back. I think there are a couple of more provisions same there. Okay, contingent asset. This is a good one. All right. You might have studied in your CA Inter or IPCC something known as loss of insurance claim. There was one chapter. Under that, there was something known as loss of profit policy, if you remember. Yeah, there was a big problem. Some steps you used to do. Big problem it was. Yes. So in this, there's a guidance given on that. So what is happening is, due to COVID, profits of many businesses are getting eroded, meaning companies' profit is significantly reduced. If company is smart and if they've taken loss of profit policy means what? If company suffers any loss, insurance claim will compensate for that loss of profit. Yes. So there's a guidance given on that. So we'll read the guidance directly. A company has taken a loss of profit policy. They've already taken. Okay. And due to COVID, obviously, company has lost significant profits. Because of lockdown, they were not able to operate. So, profits have obviously reduced. So, what? Now, insurance company will have to reimburse that money. Now, the question that arose was, can I recognize this as an asset? Because we'll receive some claim from insurance company. Can I show that asset? Or if I can show that asset, when can I show? Can I show that asset when the company makes the claim? Or should we show that asset when insurance company pays the claim or settles the claim? This was the question mark. When will you recognize it as an asset? Okay. Now, simple funda. See, we had, if you remember a provision ka chart, when will you recognize the asset? When there is virtual certainty. Till there is virtual certainty, you will not recognize the asset. If it is probable asset, meaning more than 50% chance that you will recover the money, then you will disclose contingent asset, not account. You will just disclose contingent asset. So you have to check at what stage is the claim therein. If insurance company has already accepted the claim, they have written a letter saying, okay, we hereby approve your claim. They have accepted your claim means then you can go ahead and recognize it as an asset. That claim you can recognize it as an asset. But if you have just submitted the claim, or if you have started discussing it with the insurance company, either submitted or you have started the discussion, then if you are confident, if the company is confident, if they feel there are high chance, if it's highly probable, meaning more than 50% chance that we will recover the money, meaning highly probable, then you will disclose contingent asset if probable. Okay, that was a pointer regarding that. That's all. Right? Basically, when will you record that asset? This is that pointer relating to that. Okay. This is on contingent asset. Third issue was on CSR, corporate social responsibility, CSR spending. Now, contribution, we'll directly read through this, a simple one. A contribution has been made to COVID relief fund, Prime Minister's relief fund, Chief Minister's relief fund, like this various fund was opened. You and I, everybody would have contributed some money, how much ever was possible from our side. Yes, everyone did contribute. Yes. So, the contribution made under the COVID-19 relief fund after 31st March 2020. Let's say the year ends on 31st March 2020. Okay, after 31st March, a company has made contribution. After 31st March means it comes in next year. Next year means financial year 2021. The company has made the contribution. But if you just check, if you remember the income tax laws, they amended, right? They told thing. What is the deduction they told? As per tax laws, though you contributed to the COVID relief fund after 31st March, still in 1920, in the current year itself, you can claim the deduction. I think till June or July. Yes, they had extended 3-4 months. They had given time because March month many people were not able to contribute, and they had extended the time. If you contribute up to June or July, though June July comes in next year, you can claim the deduction in the previous year, that is financial year 1920 itself. This was done in tax law. They extended that time, 3-4 months they gave it. Same thing, considered as CSR expenditure for financial year 1920, though you spent the money in 2021 as per Companies Act CSR provisions, it was considered that you had spent for CSR in 1920 itself as per Companies Act. Even Companies Act, they gave the leeway, okay, they give you that benefit. Tax law also, you got the early deduction benefit, okay. Now the question that was arising is, when should we account that in our books? Both these laws, tax laws and company law, though we spent the money in 2021, they are giving me the deduction in 1920 itself. So the question that arose was, should we account that expenditure in financial year 1920 or 2021 when you actually spent it? In books, when will you show that expenditure? This was not really required as such, because we clearly, what does accrual concept says? Whenever transaction accrues, that's when you will account it. Here transaction happened only in next year means you will obviously account it in next year only. Okay, just because tax laws and company law is giving you that exemption, okay, does not mean you will change the whole pattern of accounting as such. Accounting will run same way only. Meaning, since you spent it in 2021, CSR expense will be booked in accounts in 2021 only. You can't record it before. That's a clear clarification given as such. That means there will be difference as per accounts books and tax books. So we should create deferred tax? Absolutely yes. You create deferred tax liability. Why deferred tax liability? Simple one, we can check. In tax laws gave you deduction, correct? You could have claimed that as an expense as per tax laws in the current year only. Books may say you will claim it in next year. That means expense as per tax is what? Expense as per tax is more. Remember this equation we had written? If expense as per tax is more, because you got the deduction, expense as per tax is more. If expense is more means what is taxable profit? If expense is more means taxable profit will be less. Higher the expense, lower the profit. Yes. If taxable profit is less means tax in the current year also will be lesser. But in the future year, tax in future year will be more. Yes. Because you will not get the deduction again. No? Tax in future year will be more. Since you have to pay more tax in the future year, it implies that you have to create something known as deferred tax liability. We had written this equation. I'm just recapping it for you. Okay. Hence, on this component, we have to create something known as deferred tax liability. Simple 2 guidance. Though tax laws and company laws is giving you early deduction benefits and all, and accounts you will book it in the year it has accrued. That will not change. And because of this, there will be some differences between tax records and book records, accounting income. Hence, DTL recognition becomes a necessity. That is only 2 points with respect to CSR as such. Okay, all these are straightforward questions. Okay, maybe contingent asset ka we can just quickly run through the question. Okay, other one maybe I'll give it to you as homework itself. Okay. A reputed event and conference management company has obtained a loss of profit insurance cover. They have taken a loss of profit policy to mitigate the risk of potential business losses due to circumstance beyond its control, like COVID. Due to the current accounting year, it has estimated loss of profit of certain amount and initiated, the keyword is this, and initiated the discussion with insurance company. Insurance company has not accepted your claim. You have just discussion. In the initial stage of discussion you are in. The entity is confident that insurance company will admit and honor the claim of profits. Entity feels there is a high chance that we'll recover the money. But has insurance company accepted the claim? No. Accordingly, entity is considering recognizing an asset for this insurance claim. Is it acceptable? No. You can't recognize it as an asset. You can only disclose if it is highly probable. Looks like it is highly probable here. You can disclose contingent asset, that's all. Because you have just initiated the claim. The claim is not accepted. If the claim was accepted, you could have recognized it as an asset as such. Okay. Alright, this is with respect to CSR. There is nothing in this. You can just run through on your own. It's the same what we just discussed now. Okay, now it's all small words. Fatafat we can do it off. India's 19 employee benefits. The problem here was, so due to COVID, most of us had to work from home. Okay, and let's say few employees were sent on temporary leaves without pay. See, like if you have a factory, okay, normally if you see factory workers, they don't come in their own vehicles. The company arranges transport for them. Okay, they come using company vehicle, work, and 5:30 or 6 o'clock they log out. Company bus will take them back home. That's how like normally manufacturing units work, correct? No, like you, okay. But now due to lockdown, because like the workers and all come from far off places also, if you just check. All right, so normally companies do arrange for transport facilities for them. They don't come on their own. Now due to lockdown, the factories, they were not able to make transportation arrangements for their employees. And since the transport was not available, the employees could not come. So some of the employees, the company told the employees, okay, you take leaves, but leave with pay for you. We will not deduct salary from your account, but you stay, maja madi, okay, relax, chill pill, okay, Netflix and chill madi, okay. So they were sent on temporary leaves, but they were with pay. Now the question was, some questions were shooted that, let's say okay, lockdown, let's say, has happened in 22nd March, I guess, 22nd March 2020, okay, let's say till 31st March 2020. Let's say this factory comes under essential division, so they got the permission to open the factory on 1st May 2020, let's say. They got permission to open it. From 21st March, or not 31st March, we'll give it like this only. Lockdown happened here. The factory was closed on this date. The factory resumes the operations on this date. For these many days, whatever the number of days are, let's say it is 40 days for simplicity. Okay. For these 40 days, employees were given leave, but with pay. Now, leave with pay, paid leave means it is considered as short-term employment benefits. Yes, no, this is STEB, short-term employment benefits. The question that arose was, when should you account this short-term employment benefits? Meaning, the leave from 22nd March to 31st March 2020. This period ka leaves comes within current financial year. Some questions which company was asking was, can we account this expenditure, this paid leave expenditure, when the company resumes the work? can we account this period this 8 or 9 days paid leave which was given, can we account it when the company resumes the operation, or rather when the employees come and do the work, which is on 1st May? That was a question that was raised. Quite actually baseless, because you'll recognize the expense as and when it accrues. This has accrued in 1920 financial year. It has to be accounted in 1920 financial year. The problem of procrastinating or pushing the revenue is not validated, is not acceptable. That is what they have told there. Okay. STEB cannot be, that is short-term employment benefits. The paid leave which was given cannot be deferred and recognized when employee resumes work or when company resumes the work, but should be recognized as and when it accrues. Meaning this 10 days ka leave you should recognize in this year only. Okay. Balance 30 days ka leave which falls in next year should be recognized next year only. This 10 days ka leave cannot be deferred and recognized next year. It is not acceptable is what they guided on. Okay, pretty much straightforward. Nothing much as such. Yes. Alright. Next, Ind AS 102, that is share based payment. Here again, not really necessary. We know this, but still we'll just reiterate. Market related vesting conditions. You know, vesting conditions of two types, market related, non-market, service related, and other thing. Yes. So if you have any market related vesting conditions, like we will give you this many shares to the employees or whoever, if market price of the entity reaches this level, let's say market price is 100, if it reaches 150, we will give this many shares to you. If that condition is imposed in the plan, those we call it as market related vesting conditions. Okay, a clarification is given with respect to that regard. In theory, not much. Problem actually we have done in our regular share-based payment class itself. You can go through, but just I'll reiterate. If market price has fallen and company expects vesting will not happen. So when will we give the shares to the employees? When the shares price increase and when it reaches a certain level. Now due to COVID, share prices and all was falling. If the share price has fallen steeply, it's fallen a lot, and if company feels it will not raise to that level again, okay, it's very difficult to raise, okay, so vesting will not happen if the company concludes that. Should we revise the vesting period, or should we revise the fair value of the option, or can we reverse the employee benefit expenditure already recognized? These are the questions that came through. We already know if it is market related vesting condition, then fair value of the option, vesting period and all will not change. Whatever expense you are booking before, okay, same thing will continue. Reversal of employment benefit expenditure and all is not allowed. We have done a problem based on this also. Ignore that there is a fall and do the accounting as usual. That's what I've written here. Check. Ignore the fall in market price and continue to record employment benefit expense as usual. We have done a problem based on this in our regular class. Just on extra guidance which is being given. That's it. Market relation conditions. Okay. I know. Mugitu. Yes. Too many hours of been drilling. Yeah. Okay. Few more. Last points. These are very small ones. Not much actually. Next is Ind AS 23 borrowing cost. We already discussed this. This guidance is on suspension of borrowing cost. If you remember borrowing cost, this is our old chart. Ind AS 23 clearly gives a guidance on three things. When should you commence the capitalization? And three conditions are satisfied. When borrowing cost is being incurred, expenditure on qualifying asset is being incurred, work on the qualifying asset is being carried out. The day these three conditions are satisfied, you will start commencing the capitalization of borrowing cost. And when will you stop capitalization, meaning cessation of borrowing cost will happen when the asset is substantially, work on qualifying asset is complete. And Ind AS 23 gives you a clear guidance on suspension of capitalization also. Meaning, when should you temporarily stop? If there is any delay in qualifying asset means those assets which take substantial period of time to get ready for management intended use, like building. Okay, if you buy, let's say you bought an AC. You bought an AC and you can install it that day itself. Maybe in 1 or 2 days you can install. So it is not a qualifying asset because it is not taking substantial period of time. Suppose you're constructing a building, office building, so you're constructing. Will it be ready in 1 or 2 days? No, it may take 2 or 3 years. Yes. So that could be considered as a qualifying asset. So if there is any borrowing cost incurred on qualifying asset, then it should be capitalized. When to capitalize? This condition. Okay. When to stop capitalization? This provision. Suspension. If the work on qualifying asset, okay, is delayed, is suspended. If you stop, or rather if active development, I think we have written here, if active development on qualifying asset, if it is suspended, meaning if work on qualifying asset is stopped and the delay is other than temporary, okay, then you have to suspend the capitalization of borrowing cost also. Let's say due to, we have written also, if work on qualifying asset is suspended, meaning stopped due to abnormal events, like, see, actually this itself is giveaway, abnormal events like natural calamities, labor strike, fund shortage, you can also write COVID. Due to lockdown or COVID, if the work on qualifying asset, let's say you're constructing a building, due to lockdown, if you're not able to construct the building, the work on building stopped, meaning suspended, then borrowing cost capitalization also gets suspended, meaning that period, let's say for 4 months you are not able to construct the building due to lockdown. That means the borrowing cost for those 4 months will not be added to the cost of building. It will be added, it will be transferred off to P&L. That is a provision, okay? That is what they've given here. If active development on qualifying asset, this is the guidance given. If active development on qualifying asset is suspended, okay, due to COVID, then borrowing cost capitalization also will be suspended, meaning borrowing cost for that period will be expensed off, meaning transferred to P&L. Simple guidance, nothing much there. Okay, if you see that there in the question they're saying work is suspended due to COVID, then you will tell that there is an abnormal event, hence borrowing cost suspension should be, borrowing cost should be suspended, meaning it should be transferred off to P&L. That's it. That's all you'll write and move on. Okay, that's a simple guidance, a very simple provision as such. Yeah. Next, IND AS 20 government grants. What is the guidance given here? If you just check as a relief measure, what did the government do? Government told employer's share, not employee, employer's share of PF. Who has to pay employer's share? Employer itself. But the government told the employer, I know that you are facing cash shortage. Employer share, meaning your share of PF, government only will bear, we will bear. Okay. So government told we will pay. Okay. Now, is this considered as a grant under IND AS 20 was the question. Employer's share of PF paid by the government as a relief measure. Is this a government grant was the question raised. Clearly they given guidance that yes, it is a government grant. How? So government grant means transfer of resources. No. Here where government is not giving us cash, they are not giving any assets. How is it? Sir, government undertook one liability or it waived off one liability. That is also a transfer of resources. Transfer of resources does not mean resource should come into you. If any liability is waived off, that is also a transfer of resources. Why is it a government grant? Because liability is waived off. Liability is waived. If liability is waived, that is also nothing but is a transfer of resources. Okay. It's given in the question, in the solution, but these are simple things. So hence, even if you choose to skip solving the question, this is good enough. Hence, I've written it here only. Okay. So if any relief measure, if this is given by the government, then that will also be considered as a government grant, because one liability is waived off, that will be treated as transfer of resources and it will be treated as government grant, not assistance. Assistance means, you remember that example we had given you, speedy pushing of the files, administrative help, marketing help and all that stuff. Basically government grant means you can quantify how much. Assistance you cannot quantify. Like you want to set up a factory. Let's say you have to get 40 permissions from various government agencies. Okay. Government of Karnataka told, you don't have to go to 101 places. Just come to me. I will clear all your files at one place in one location. Speedy clearance of file government told you. We will go, Karnataka government told you. That is also a government assistance because you cannot quantify that. Those we call it as government assistance. If you are receiving any cash or any assets, then it will be treated as government grant because those can be quantified. Government grants are accounted. Government assistance are disclosed. That's another pointer. We have written all this in our old charts. Okay, so that's about government grants. Problem is very straightforward things on based on this. Okay, so I think we can go for the next one. It's okay. It doesn't make too much sense to do that same things again and again. Yeah. All right. Next, IND AS 38 intangible assets. Now, perfect example. If you remember, internally generated intangible assets. If you just check, I think I can show you the chart maybe. Here. Internally generated intangible assets are classified either as goodwill and others. Internally generated goodwill, will you recognize? No, you will not recognize it as an intangible asset. Okay. but annual impairment will come. That is for goodwill arising on as per Ind AS 103 business combination. Now we're not talking about this goodwill, we're talking about others. Internally generated assets, other intangible assets other than goodwill, they are classified into research phase and development phase. Research phase expenditure as a thumb rule will go off to P&L. Why to P&L? Because at research phase you will not be able to demonstrate whether intangible asset really exists and how much future economic benefits, that is FEB, will come because of that. Hence research phase expenditure goes off to P&L. But development phase expenditure, can you capitalize? Yes, we've been telling that development expenditure can be satisfied if TIAFRC is satisfied. T for technical feasibility, I for intention to complete, A for ability to use, F for the future economic benefits, how much will come, what extent will come, R means the financial and other resources, C for cost measurement. If all these conditions are satisfied, TIFRC, then you can recognize development expenditure as an intangible asset. This is the recap. Okay. Right. Now the guidance, coming back to the guidance, what they said is, now to find COVID vaccine, many companies are doing the research. They are putting a lot of efforts in that direction. Now a company is looking to develop a COVID vaccine. Can they recognize those efforts as an intangible asset? Because they'll obviously incur certain cost. Those expenditure which they've incurred, can they recognize it as an intangible asset was the question. Same rule, okay, whatever we have done. If they're developing COVID vaccine, check at which stage is the vaccine in. If it is still in research phase means knowledge acquisition phase, then it straight away it will be expensed off, meaning it will go off to P&L. If it is in development phase, then can you recognize it as intangible asset? Very much yes, provided TIAFRC is satisfied. Okay, that's the same guidance. All right, they have given as such. Check which stage is there, and if it is past trials, you check which stage basically, and accordingly take a call as such. All right, but one more thing you need to keep in mind is impairment of that. Okay, let's say a particular company, they've reached development phase and they also feel TIFRC is satisfied. Okay, they are in that clinical trials they are in. Right now they are testing the vaccine, let's say on animals. Okay, they're showing good results. All right, they're confident that it will also clear human trials also. Okay, fine. Or let's say human trials is also cleared. A particular vaccine, I think that's been announced now also, I guess. Yeah, let's say a particular vaccine, human trial is also cleared. Okay, they have now you can recognize it as intangible asset. Can you show directly as intangible assets? No, you have to show it as intangible assets under development, because still there will be many stages, right? Correct? After an animal trial, then you'll have to just check the human trial, you have to do so many samples, there'll be many criteria. So you will show it as intangible assets under development. Let's say you recognize that as an intangible asset under development. Okay. This company feels they'll be able to sell the vaccine. Okay, they'll be able to make the vaccine at 5,000 rupees. One vaccine, right? Vaccine ka shot. Let's say they're producing it in injection form, like solution format. Okay, one shot of that COVID vaccine costs about 5,000 rupees. Okay, they're pretty confident, things are going super awesome for them. All right, so they've recognized it as intangible assets under development. The cost of, they feel they'll be able to sell these COVID shots at 5,000 rupees. There is another competitor. Okay, his also has reached development phase. He has also recognized intangible asset because TIFRC is satisfied for him also. He is making the claim that he'll be able to produce this COVID shot at 1,000 rupees. Okay, his cost is just 1,000. Now you think financially, yes, this company, let's say this is A, let's say this is B. Though A Limited will be able to produce vaccine, will they be able to sell this? No, because of competitor is coming at almost 1/5 of the R price. Correct? So yes, that means though we have produced vaccine, we'll not be able to recover so much from it, because probably because of the cost, we'll not be able to recover it. So that means our recoverable value of intangible asset will be lot lesser than the carrying amount. So you may have to recover or recognize impairment loss. So if carrying amount of intangible assets under development is greater than the recoverable amount due to competitor's action or due to anything, generally due to competitor action in these cases, then impairment loss should be recognized. If only in that case, carrying amount, if it is greater than tax base, that's it. Okay. These are the pointers with respect to intangible assets. Same thing. Same, there's no new guidance. This you could consider it as a new guidance. It was there, but just there, reiterating as such. With respect to intangible asset, these are the guidance. Next is on IND AS 21, effects of changes in foreign exchange rate. Okay, before I get to the guidance, I would like to just retrace your memory back to this. This is our IND AS 21 old chart. If you remember, IND AS 21 said, if you have any monetary item means those whose value is fixed, meaning expressible in fixed denominations of currency, whose value is fixed. If there is a monetary item, then exchange gain or exchange loss on monetary item should be transferred to P&L. That's what IND AS 21, AS 11 also told the same thing. Yes, exchange gain or loss on monetary item should be transferred to P&L. Okay, but accounting standard 11, I'm not using the word IND AS, I'm using the word accounting standard 11, old previous gap for accounting standard, IPCC days. Yeah, accounting standard 11. If you just check para 46A exemption, if you remember, we have referred that so many times in our problems, right? So, if what AS 11 told was, check if there is any long-term foreign currency monetary item. Long-term foreign currency, let's say long-term foreign currency loan. You have taken a loan for, let's say, for a period of 5 years from US. So, long-term foreign currency loan. Check what is that loan used for. If it is used to buy property, plant and equipment, then if this long-term monetary item is used to buy property, plant and equipment, then AS 11, para 46A of AS 11 told exchange gain or loss on this long-term monetary item, you need not transfer to P&L. It's not compulsory. There's an option which AS 11 gave. If you have used it to buy PPE, then exchange gain or loss on this monetary item need not be transferred to P&L. It can be capitalized to property, plant and equipment, meaning you can add it to the cost of the asset. If it's exchange loss, you'll add it to the cost of the asset. If it is exchange gain, you'll reduce it from the cost of the asset. That was the option given under AS 11. However, if you have used it not to buy, if this loan is used for other purpose, not for PP, but for other purpose, then exchange gain or loss, still you need not transfer to P&L. You can accumulate it and book it in a reserve known as FCMITD or FCMITR. Foreign currency monetary item translation reserve or foreign currency monetary item translation difference. You can accumulate that gain or loss in this FCMITD or FCMITR, and from FCMITR it will go to P&L only, but over the duration of the loan on a straight line basis over the loan term. If the loan term is 5 years, over 5 years from FCMITR you will transfer it to P&L, meaning you will defer that exchange gain or loss over the contract term. This was the option given under AS 11 as para 46A. Now, in AS 101, first time adoption, what it said was, if this treatment, if either this treatment, transferring it to PPE or FCMITR, if this treatment was followed as per accounting standard, let's say there is one company, let's say they were following accounting standard, and under accounting standard, this exemption they had taken, this para 46 exemption, they were taking and they were doing the accounting. Then, should be adopted by the company before IND AS. What IND AS 101 says is, if you are doing this treatment as per AS 11, you can continue the same treatment under IND AS also. Actually, under IND AS there is no option. All gain or loss of monetary item should go to P&L. But they brought in one exception. Alright, this is only in India they brought in. If you are following this policy as per accounting standard previously, then you can continue the same policy even when IND AS applies to you. This is one first time adoption, one relaxation they gave. Okay, you should have already adopted. If this treatment is as per AS, they should be adopted before the company follows IND AS. Before IND AS was applicable for them, the company should have adopted this. If they are doing that, then the same treatment can be followed after applicability of IND AS also as per IND AS 101, first time adoption. This is a carve out, meaning IFRS does not give this. In IFRS, this option is not there. As per IFRS, exchange gain or loss on all monetary items will be going to P&L only. Only in India, this differential or extra treatment is given. Okay, hence this is a carve out. This is your recap, not the guidance. This is what we had studied when we had done IND AS 21. Now coming back to the guidance, what is the guidance is, let us say there is a long-term foreign currency monetary item. Okay, company was not following para 46A exemption of AS 11. What did AS 11 tell? Either you can add it to the cost of the asset or book it in FCMITR. Okay, Let's say company was not doing that before. Even as per AS 11 also, they used to transfer to P&L only. Okay. But now due to COVID, no, exchange rates are started fluctuating too much. Okay, there is left, right, huge losses coming in. Now, the question that was put forth is, now the company, so far they have not followed that para 46A exemption. India has already applies to them. Due to COVID and now, can I defer that loss? I will not transfer it to P&L. I will defer that loss. Either I'll book it in FCMITR or some other, I'll book it in OCI basically. I'll defer it. Can I do that? Was a question that was raised. Can I take para 46A exemption of AS 11 now after India is applicable? Okay. And I had, the company had not taken the exemption before also. Okay. So the clear answer is, if you have any long-term foreign currency monetary items, then it has to be transferred to P&L. They cannot be deferred due to COVID, meaning para 46A exemption is not available due to COVID. It is only available on first time adoption. Before Ind AS was applicable to you, if we are taking that para 46A exemption, then same exemption you can do it as per Ind AS also. If you had not taken that exemption before, then sorry, now due to COVID and all, we will not give you that exemption. Meaning the gain or loss on that monetary item compulsorily will go to P&L only. Deferment is not allowed. That is what they told, sir. That's all. Alright. Basically no deferment of loan. That's what they're trying to point out. Again, straightforward questions. No issues. I think we can just skip through the question and directly go into the last component. This I think is the last clarification given. This is on Ind AS 1. Presentation of financial statements. First one is going concern. Classic indicator, right? We always say, okay, you should always test for going concern assumption. Going concern means the organization neither has the necessity or we assume that the organization will continue for a foreseeable future. What is foreseeable future? They've given a guidance little bit there, because so far going concern testing and all was not arising. Now many organizations are not a going concern because of huge liquidity problems COVID has brought in, right? So they've just given a little guidance on going concern. Okay, what guidance they've given is, entities, all the entities should check whether it is a going concern first of all. Meaning, at least it's a going concern, meaning it will continue its operation at least for a foreseeable future. Foreseeable future, they have defined it as at least for a period of 12 months from the end of the reporting period. All the organization from the balance sheet date, okay, 12 months ahead, check you will be able to continue your operation. If you are able to continue your operation for the next 12 months from the balance sheet date, then it is said that this organization is a going concern. That is what the clarification they brought in. Okay, check going concern for a period of 12 months from the end of the reporting period. From the balance sheet date till for the next 12 months, you just check. Okay, so can I take longer period? Yes, you can take period greater than 12 months. You can also test going concern for a period of 3 years, 5 years, 7 years also, provided reliable information is available. If reliable information is available, then you can use more than 12 months. Now, what is reliable information? Let's say a particular company, X or A Limited, their property, plant and equipment. The useful life of property, plant and equipment remaining is 10 years. Okay, or let's say 3 years. We'll take it simple. On an average, their property, plant and equipment still has a life of 3 years. They have license, trademark, patents and all lasting for 3 years. They have contract with employees. They made a contract with employees that the employee has to stay in the organization for 3 years. The perfect example could be revenue contracts. They have contract with customers. They have sale contracts for a period of 3 years. Okay. So in this case, you have clearly a reliable information. Actually, this itself is very good information. If you have contract with the customers for 3 years, that means you have reliable information for more than 12 months, meaning here you have it for 3 years. Then you will test the going concern for period of more than 12 months, meaning in our example, 3 years. Okay. So that's what it is. So basically you have to test the going concern for a period of 12 months from the balance sheet date. If you have reliable information, test it for a longer period. If entity, however, fails the going concern test, this we have already done, it's just a recap. If entity fails going concern test after balance sheet date, but before the approval of financial statements, then still it is an adjusting event as per Ind AS 10. This was an exception. We have already done this. This is just told. If you just check our old chart, you will find this. Yes, though adjusting event means condition should exist on balance sheet date. But here, you found out the organization is not a going concern after balance sheet date. But still, this will be treated as adjusting event, and still, you can't prepare your financial statements on that basis. You have to prepare it on a different basis. Okay. So that is what. This is an exemption of Ind AS 10. This is a reiteration. It was already there. Okay. I think we had done one problem also, if I remember correctly. I'm not very sure. You can just check. The theory part, definitely we have discussed on this. Okay. That is the thing on going concern. Last point is on extraordinary items. Now the issue was arising was, due to COVID, you're booking huge losses. You're booking huge impairment losses. You're writing off inventory to net realizable value. All this can companies show it as extraordinary item because clearly it is distinct. Actually, as per Ind AS, there is nothing. We have already told this before. In Ind AS, there is no concept of extraordinary item. Okay, if you just check, nowhere they mention the word extraordinary item. But if you just check profit and loss statement schedule, there you will find something known as exceptional items. Ind AS says there is no extraordinary items. Ind AS also says that if there are material items, it should be disclosed separately. But in our schedule, no, we have exceptional items. So what the guidance notes is, if you are booking any huge impairment losses, or if you are writing the inventory to net realizable value, it cannot be shown as extraordinary items, but it can be shown as exceptional items. That is the guidance given. So that's what I've written here also. As per Ind AS 1, presentation of financial statements, no item of income and expense can be shown as extraordinary item. But however, as per the same Ind AS, material items can be shown separately, meaning it should be shown separately. But in our schedule, we have something known as exceptional item. Hence, any losses due to COVID-19 can be shown as exceptional item. One of the example is inventory reduced NRV or impairment loss also you can bring in. Okay. So this is the guidance with respect to Ind AS 1, going concern and extraordinary items. Question is very, very straightforward, no numerical, same thing I've given. I think those questions, anyway, I've told you that files are available on the app. You can go through it for yourself. So I think with this, all the concepts and questions are done for. In the same fashion, we'll be doing the amendments also. Amendments are less in number, so it should not take ideally so much time. And I am telling you, these are not amendments, these are additional guidance given. Okay, this COVID clarification, what we did in today's class is just an extra guidance. And also whatever you have studied as per our regular batch, those also will remain the same. You don't have to break your head. These are extra concepts. Treat it as extra concepts, do it that way, that's it. Okay, you don't have to do any tweak or any, break your head on the existing concepts as such. Alright. Hope our session was helpful to you. I know that it was a little long, but I hope it was worth it. Alright, we'll catch up with amendments again in the next session. Till then, take care. Bye.